Welcome back, everyone. I'm excited to have you here as we continue our journey into the world of trading success with the audiobook, Trade Like a Stock Market Wizard, by Mark Minervini. This book is packed with strategies, principles, and insights from one of the most successful traders in America, someone who turned small beginnings into extraordinary returns. In this audiobook, we'll explore Minervini's methods step by step, covering the mindset, strategy, and discipline needed to consistently profit in the stock market. Here's a quick look at what's ahead. Chapter 1, an introduction, worth reading. Get to know Minervini's background and why his trading philosophy has helped him achieve remarkable results. Chapter 2, what you need to know first. Learn the core principles and foundations every trader must understand before entering the market. Chapter 3, specific entry point analysis, the SEPA strategy. Discover Minervini's famous SEPA strategy for pinpointing high-probability entry points. Chapter 4, value comes at a price. Understand how to weigh value versus price and why paying up for quality stocks often pays off. Chapter 5, trading with the trend. Master the art of trend trading and why aligning with the market's momentum is critical. Chapter 6, categories, industry groups, and catalysts. Explore the importance of industry leadership and the catalysts that drive big moves. Chapter 7, fundamentals to focus on. Learn which fundamentals truly matter when identifying winning stocks. Chapter 8, assessing earnings quality. Gain insights into how to judge earnings reports and spot companies with genuine strength. So sit back, relax, and get ready to absorb proven trading wisdom that can sharpen your edge in the market. Let's dive into Trade Like a Stock Market Wizard and uncover the strategies that have helped Mark Minervini achieve legendary success.
Chapter 1, an introduction worth reading. Champions aren't made in the gyms. Champions are made from something deep inside them, a desire, a dream, a vision. Muhammad Ali, 3-time world heavyweight boxing champion. In the heat of competition, champions rise to their strengths, triumphing over mere contenders. Marathon runners win through superior endurance and a keen sense of pacing. The great flying aces of World War I defeated their enemies, winning dogfights by thinking faster and better in 3-dimensional space. At the chessboard, victory goes to the player who sees more clearly through the maze of possible moves to unlock the winning combination. Virtually every human contest is dominated by the few who possess the unique traits and skills required in their fields. The stock market is no different. Investing styles may differ among successful market players, but without exception, winning stock traders share certain key traits required for success. Fall short in those qualities, and you will surely part ways with your money. The good news is that you don't have to be born with them. Along with learning effective trading tactics, you can develop the mindset and emotional discipline needed to win big in the stock market. 2 things are required: a desire to succeed and a winning strategy. In Trade Like a Stock Market Wizard, how to achieve super performance in stocks in any market, I will show you how my winning strategy brought me success and how it can do the same thing for you. I've been trading and investing in the stock market for most of my adult life, 30 years and counting as of the writing of this book. Stock trading is how I made my living and ultimately my fortune. Starting with only a few $1,000s, I was able to parlay my winnings to become a multimillionaire by age 34. Even if I had not become rich from trading stocks, I would still be doing it today. For me, trading isn't a sport or just a way to make money. Trading is my life. I didn't start out successful. In the beginning, I made the same mistakes every new investor makes. However, through years of study and practice, I gradually acquired the necessary know-how to achieve the type of performance you generally only read about. I'm talking about super performance. There's a big difference between making a decent return in the stock market and achieving super performance, and that difference can be life-changing. Whether you're an accountant, a school teacher, a doctor, a lawyer, a plumber, or even broke and unemployed as I was when I started, believe me, you can attain super performance. Success requires opportunity. The stock market provides incredible opportunity on a daily basis. New companies are constantly emerging as market leaders in every field, from high-tech medical equipment to retail stores and restaurants right in your own neighborhood. To spot them and take advantage of their success, you must have the know-how and the discipline to apply the proper investment techniques. In the following pages, I'm going to tell you how to develop the expertise to find your next super performer. Follow your dreams and believe in yourself. Impossible is just a big word thrown around by small men who find it easier to live in the world they've been given than to explore the power they have to change it. Layla Ali. Dedication and a desire to succeed are definitely requirements to achieve super performance in stocks. What is not required is conventional wisdom or a college education. My real-world education began when I was an adolescent. I dropped out of school in the 8th grade at age 15, which means that I am almost completely self-educated. Yes, you read that correctly. I left school at age 15. I have never seen the inside of a high school as a student, let alone attended a university. What I did have, however, was a thirst for knowledge and a burning desire to succeed, to be the best trader I could be. I became a fanatical student of the stock market, its history, and human behavior. I started out by reading the financial news and stock reports at the local library. Over the years, I've read an incredible number of investment books, including more than 1,000 titles in my personal library alone. In light of my lack of starting resources and formal education, the level of success I have achieved strikes some people as unlikely or even impossible. Along the way, some have even tried to discourage me. You too probably will face people who will try to dissuade you from trying. You will hear things such as it's a rigged game, you're gambling, and stocks are too risky. Don't let anyone convince you that you can't do it. Those who think it's not possible to achieve super performance in stocks say so only because they never achieved it themselves, and so it's hard for them to imagine. Ignore any discouragement you may encounter and pay attention instead to the empowering principles I am about to share with you. If you spend time studying and applying them, you too can realize results that will amaze even the most ambitious positive thinkers. Then the same people who said it couldn't be done will ask you the question they always ask me: how did you do it? And the trade shall set you free. From the very beginning, I saw the stock market as the ultimate opportunity for financial reward. Trading also appealed to me because I liked the idea of having the freedom to work at home and taking responsibility for my own success. In my young adult years, I had tried several different business ventures, and even though I felt enthusiastic, that burning passion was still missing. Finally, I came to realize that what I was most passionate about was freedom, freedom to do what I want when I want where I want. One day it dawned on me, life is rich even if you're not. I realized that things were happening every day, good and bad, and that it was just a matter of deciding what I wanted to be part of. People were getting rich in the stock market. I said to myself, why not be part of that? I figured that if I learned how to invest in the market and trade successfully, I could achieve my dream of financial freedom and, more important, personal freedom. Besides, who was going to hire a junior high school dropout? The stock market was the one place I could see that had unlimited potential without prejudice. The author and successful businessman Harvey Mackay said it perfectly: optimists are right, so are pessimists. It's up to you to choose which you will be. Achieving the best of both worlds. When I started trading in the early 1980s, I had only a few $1,000s to invest. I had to make huge returns on my relatively small account to survive and still have some trading capital left. This forced me to hone my timing and learn the necessary tactics for extracting consistent profits out of the stock market day in and day out. Like a pro poker player who grinds out a steady living while consistently building a bankroll, I became a stock market rounder. My philosophy and approach to trading is to be a conservative, aggressive opportunist. Although this may seem like a contradiction in terms, it is not. It simply means that my style is to be aggressive in my pursuit of potential reward, and at the same time be extremely risk-conscious. Although I may invest or trade aggressively, my primary thought process begins with how much can I lose, not just how much can I gain. During my 30 years as a stock trader, I've discovered that a risk-first approach is what works best for me. It has allowed me not just to perform or perform well, but to achieve super performance, averaging 220% per year from 1994 to 2000, a 33,500% compounded total return. including a U.S. Investing Championship title in 1997. My approach also proved invaluable when I needed it the most, cashing me out ahead of 8 bear markets, including 2 of the worst declines in U.S. stock market history. By adhering to a disciplined strategy, I was able to accomplish the most important goal of all, to protect my trading account and keep the profits I made during the previous bull markets. Invest in yourself first. When I began trading in the early 1980s, I endured a 6-year period when I didn't make any money in stocks. In fact, I had a net loss. It wasn't until 1989 that I began to achieve meaningful success. What kept me going? Unconditional persistence. When you make an unshakable commitment to a way of life, you put yourself way ahead of most others in the race for success. Why? Because most people have a natural tendency to overestimate what they can achieve in the short run and underestimate what they can accomplish over the long haul. They think they've made a commitment, but when they run into difficulty, they lose steam or quit. Most people get interested in trading, but few make a real commitment. The difference between interest and commitment is the will not to give up. When you truly commit to something, you have no alternative but success. Getting interested will get you started, but commitment gets you to the finish line. The first and best investment you can make is an investment in yourself, a commitment to do what it takes and to persist. Persistence is more important than knowledge. You must persevere if you wish to succeed in anything. Knowledge and skill can be acquired through study and practice, but nothing great comes to those who quit. When opportunity meets preparedness. When people hear my success story, the 2 questions they ask most often are, how did you do it? And did you just get lucky? The assumption is that I must have taken a lot of big risks or been lucky along the way. So how did I do it? For years, I worked on perfecting my trading skills, plugging away 70 to 80 hours a week, often staying up to pore over stock charts and company financials, until the sun came up the next day. Even though the results weren't there yet, I persevered. I spent years separating the proverbial wheat from the chaff, perfecting my process by analyzing my successes and, more important, my failures. I invested countless hours in learning how great investors approached the market and how they created and executed trading strategies, and developed the emotional discipline required to follow their models. Then something wonderful happened. My preparation intersected with opportunity. I had been honing my skills for years, and by 1990 I was fully equipped to take advantage of a new emerging bull market. With all the lessons I had learned from my trial and error days in the 1980s, the pitch was now coming across the plate, and I was staring at my chance to knock the ball out of the park. I was 100% prepared, like an Olympic athlete who has practiced and is now ready to perform with perfection. Opportunities in the stock market can spring to life on short notice. To take advantage of them, you must be prepared and ready to act. Right now, somewhere out in the world, someone is tirelessly preparing for success. If you fail to prepare, that somebody probably will make big money while you only dream about what you could have been and should have done. So prepare, because when opportunity knocks, which it definitely will, you want to be there to answer the door. Seize permanent knowledge. In the following pages, I will share with you a plethora of information as well as specific tactics to help you succeed in stock trading, but there is no substitute for real-life experience. Just as you cannot learn to ride a bicycle from a book, the only way you can accumulate experience is by taking action and producing results, and then learning from those results, good and bad. Unfortunately, experience cannot be force-fed. It must be acquired personally over time. However, as you go through trials and tribulations during your learning curve, keep in mind that once acquired, the skill of proficient stock trading can never be taken from you. No one can fire you from your craft the way a boss can from a job. It's just you and the market. All you have learned and the experience you have gained can bear fruit for many years to come. Truly, this is what makes acquired knowledge and first-hand experience the greatest tool to succeed and build upon in stock trading and in life. Put passion at the wheel. The best traders wake up every day excited about trading and speculation. They can't wait to get to work each day and find their next super performer. They are challenged by the markets and feel the same passion and excitement that drives athletes to greatness. Michael Jordan became the greatest basketball player in history because he had passion for the game, not because he was motivated by commercial endorsements. So it is with great traders. They are motivated not just by money, but above all by their passion to become the best they can be. Passion is not something you can learn, it comes from within you. Passion transcends monetary reward. Don't worry, if you are doing something you truly enjoy and you are great at it, whether you're the best writer, lawyer, archaeologist, or basketball player, or the world's foremost authority on dung beetles, the money will come your way. For me, the greatest success came when I finally decided to forget about the money and concentrate on being the best trader I could be. Then the money followed. Those of you who enjoy investing and the art of speculation can learn the techniques and disciplines needed to succeed in the stock market. Concentrate on being the best you can be, and the money will follow. The main thing is to let your passion drive you. The best time to begin. You don't have to be great to get started, but you have to get started to be great. Les Brown. Every day we have the opportunity to make choices and shape our future. Every day is the first day of the rest of our lives. At some point, those days are gone. You can choose to learn from or regret your failures and also rejoice in your triumphs. However, the sooner you begin pursuing your dreams, the sooner you can achieve them. If you truly want success trading stocks, take action right away. You don't need anyone's permission or any reason other than you've decided to stop wasting valuable time that you will never get back. It all begins with beginning. You can dream, you can think positively, you can plan and set goals, but unless you take action, nothing will materialize. In his book Possibility Thinking, Robert Schuller said, "It's better to do something imperfectly than to do nothing flawlessly." An ounce of action is worth pounds of theory. In the stock market, you can make excuses or you can make money, but you can't do both. It's not enough to have knowledge, a dream, or passion. It's what you do with what you know that counts. Even if you don't become wealthy by doing what you're passionate about, you will at least be happy. The best chance you have to succeed in life is to do what you enjoy and give it everything you've got. When you get up each morning and do what you love, you never work a day in your life. Those days can begin today. The best time to begin is right now, a time to share. If you cannot, in the long run, tell everyone what you have been doing, your doing has been worthless. Erwin Schrödinger. You may wonder why I chose to write this book now. More than a decade ago, I was approached by several major publishers, but I decided not to proceed. Yes, authoring a book gives one credibility and prestige and maybe even boosts one's ego. Although the offers were tempting, I hesitated. I thought to myself, why should I give away all my hard work for a relatively small sum of money, especially since most people probably won't apply it correctly? Admittedly, I was being a bit cynical. Then I realized that if even one individual put forth the effort that I did in my earlier years, perhaps my book could help that person achieve his or her dreams. Perhaps my work could make a real difference for someone else. Perhaps that someone is you. Since my early 20s, I have been inspired by the words of Dr. Wayne Dyer, the internationally known motivational speaker and author. Not long ago, I reread his book 10 Secrets for Success and Inner Peace, in which there is a chapter titled, "Don't Let the Music Die Inside You." That chapter really struck a chord with me. My father died relatively young in his 50s. Later, my mother became sick and recently passed after a long battle with an illness. This prompted me to think about my life. Over the years, I have accumulated a treasure chest of knowledge and expertise. I came to the realization that it would be a waste to let it all just fade away. Books written by great traders provided me with a foundation to build on, a passing of the torch, one might say. Similarly, I would like others to benefit from and further advance my work. The stock market provides the greatest opportunity on earth for financial reward. It also teaches great lessons to those who win and those who lose, an education that goes well beyond trading and investing. Without a doubt, the stock market gives you incredible exhilaration when you win and deep humility when you lose. It is the greatest game on earth, and for me it has proved to be the greatest business opportunity on earth. To realize profits from investing in stocks, you must make 3 correct decisions: what to buy, and when to sell. Not all of your decisions will turn out to be correct, but they can be intelligent. My goal is to assist you in making these decisions to the utmost of your ability so that you will make quality choices. I have spent most of my life perfecting my stock trading methodology, and now, in the following pages, I am going to share these principles with you in detail. Armed with this valuable knowledge, I trust you too will enjoy success in the stock market and pass the torch again. Most of the examples in this book involve stocks that I traded for myself between 1984 and 2012. This is road-tested research that is very near and dear to me. I hope that you will gain useful insights from this hard-won knowledge, and that my story of success will inspire you to accomplish super performance in stocks and in life. If you're willing to work and believe in yourself, anything is possible. Chapter 2. What you need to know first. There isn't a person anywhere who isn't capable of doing more than he thinks he can. Henry Ford. Many people hope to achieve great success in the stock market, but few actually do. Over time, the average investor realizes only mediocre or inconsistent results at best. The reason for this lack of success is simply that most investors have not taken the time to study and understand what really works in the stock market and what actually accounts for super performance. The vast majority of investors operate from faulty assumptions that are based on personal opinion or theory, not unbiased facts. Only a fraction of stock traders have made the effort to carefully study the characteristics and behavior patterns of super-performance stocks. Among those who acquire the necessary knowledge, many fail to develop the emotional discipline to execute a winning plan. What is the underlying reason so many people fall short of achieving their goals and fail to have big success in the stock market? Largely, it boils down to the fact that few individuals truly believe they can achieve super performance in stocks. They've been told that a big return entails big risks, or that if it sounds too good to be true, it probably is. Let me assure you that you can achieve super performance in stocks if you so desire, and that it does not have to be a high-risk endeavor. It's not going to happen overnight, and you will most likely have to learn to do certain things that go against your natural instincts, or perhaps relearn some ingrained investment beliefs. However, with the right tools and the right attitude, anyone can do it if he or she chooses. No luck required. The more I practice, the luckier I get. Gary Player. Achieving super performance in stocks is not a function of luck or even circumstance. Contrary to what many believe, it is not gambling either. As with any great achievement, super performance is attained through knowledge, persistence, and skill, which is acquired over time through dedication and hard work. Most of all, long-term success in the stock market comes from discipline, the ability to consistently execute a sound plan and refrain from self-defeating behavior. If you have these traits, the odds are that you will succeed. With gambling, in contrast, the odds are stacked against you. If you play enough, you will definitely lose. If you think stock trading is gambling, I suppose you could say the same thing about brain surgery. It certainly would be a gamble if I were performing the operation. To a trained surgeon with the necessary expertise, though, it is a job with risks that are offset by knowledge, training, and ultimately skill. Stock trading is no different. Success in the stock market has little to do with luck. On the contrary, the more you work a sound plan, the luckier you will become. You can start small. A new idea is delicate. It can be killed by a sneer or a yawn. It can be stabbed to death by a quip and worried to death by a frown on the right man's brow. Charles Brouwer. With every new endeavor that you try, you will encounter naysayers. There are people out there who will tell you that you can't do it. If you don't have much money, they will say you don't have enough trading capital, so don't even bother trying. Nonsense. I'm here to tell you that you can get rich from the stock market even if you start small. Unless you've been successful in your professional life already, you may not have much money to devote to trading, and if you're a young person just starting out, it may seem impossible to bankroll a trading operation. Don't be discouraged. You can start out small, just as I did. A friend of mine ran into the naysayer syndrome not too long ago when he wanted to learn how to trade. Since he is a close friend, I let him come to my office each day and sit next to me to gain some hands-on experience. Trading his relatively small account, he started to understand how to make consistent trades and manage his risk. After he got the hang of it, my friend decided to trade on his own from his home. One day I heard that he had quit trading. I was surprised because he'd gotten off to a pretty good start. When I asked him why he gave up, he told me that another friend had told him that couldn't do it because his trading capital was too small and that he was wasting his time. Discouraged, my friend just gave up. Michael Dell started by selling computers out of his college dorm. Then, in 1984, he founded what became Dell Computer Corporation with only $1,000. Dell went on to become the largest personal computer company in the world. I started with just a few $1,000s, and within just few years it grew to more than $160,000. A year later it was at $500,000. With a decent bankroll at last, I was able to parlay my winnings into my personal fortune. The rest is history. I am certainly not the only one who has accomplished super performance. David Ryan won 3 consecutive U.S. investing championships, posting triple-digit returns every year. Reading about David in the mid-1980s prompted me to embark on my own quest for super performance and go on to win the U.S. investing championship myself. There are many of us out there who started small and ended up rich. What we have in common is that we refuse to let others convince us it couldn't be done. Remember, people who say something can't be done never did it themselves. Surround yourself with people who encourage you and don't let the naysayers knock you off track. No, it's not different this time. During every bull and bear market for the last 3 decades, I have heard the words, "It's different this time." Surely, during the 1920s, the legendary stock trader Jesse Livermore heard these same words. In How to Trade in Stocks, Livermore said, "All through time, people have basically acted and reacted the same way in the market as a result of greed, fear, ignorance, and hope. Wall Street never changes. The pockets change, the stocks change, but Wall Street never changes because human nature never changes. Of course, there are technological advancements along the way and some styles work better than others during certain periods. However, stocks today rise and fall for the same basic reasons as they did before. People drive stock prices, and people are basically the same emotionally. Trading can get very emotional, and emotions can easily lead investors to false conclusions. On the basis of 30 years of personal experience and historical analysis of every market cycle going back to the early 1900s, I can assure you that nothing has changed very much. In fact, history repeats itself over and over. Let the pundits clamor that it's different this time. Meanwhile, new leaders in the stock market emerge, hit the new high list, and amaze all the so-called experts. Fortunes are made and lost time and time again for the same timeless reasons. One thing you can count on is that history will repeat itself. The only question is, how good a student are you? Your greatest challenge is not the market. The world is full of people looking for a secret formula for success. They do not want to think on their own. They just want a recipe to follow. They are attracted to the idea of strategy for that very reason. Robert Greene. The best computer with the fastest processor to crunch numbers won't do anything to improve your psychology or mental preparedness. The road to success in the stock market is not a system or strategy. It's within you, and it will be realized only to the extent that you are able to control and direct your emotions as you encounter challenges, of which I assure you there will be many. You might as well know that at the start. Otherwise, you'll only be chasing false hopes. If you want a decent return, you can always put your money with a good mutual fund manager in a hedge fund or in an index fund. If you want super performance, you are going to have to go the extra mile. But first you need to understand that your greatest challenge is not the stock market. It's you. No one is going to do it for you. My first experience investing in the stock market was with a full-service stockbroker in the early 1980s, and it wasn't pleasant. In a few short months, my entire account was wiped out. Although this was painful and a major setback financially, it turned out to be one of my most valuable lessons about investing. My broker at the time persuaded me to buy stock in a biotech company that supposedly had developed an AIDS cure. He said that he had a really good indication from some important industry. Pros, that U.S. Food and Drug Administration, FDA approval was coming, and the stock would rocket on the news. Being a novice to the market, I bought that line of BS. I was blinded by the potential reward and did not even think about the risk. Shortly after I purchased the stock, it sold off from $18 to around $12. I was extremely concerned, but when I called the broker, he assured me that this was a once-in-a-lifetime opportunity and that the stock was a bargain. He recommended that I double up my position because that would lower my average cost and give me even more profit when the stock finally took off. Does this sound familiar? Long story short, the stock kept sinking, and eventually I lost all my money as I watched in horror while it fell to less than $1. Of course, the broker still got his commissions. In hindsight, this broker did me a very big favor. It was precisely at that point that I decided to do my own research and trading. I vowed I would never again surrender my investment decisions to someone else. If you aren't prepared to invest a good portion of your time before you invest your money, you're just throwing darts. At some point, you will surely be taken to the cleaners. Have confidence in your ability. Learn to do your own research and think for yourself. Your own resources are far superior to outside research, tips, and so-called expert opinions because they're yours and therefore you can keep tabs on them. No one cares about your money and your future as much as you do. Do the work, own your failures, and you will own your success. No one is going to make you rich except you. Do you want to be right or make money? After my biotech fiasco with the full-service broker, I decided to take matters into my own hands. I opened a trading account at a discount house where I met a broker named Ron. Over the course of a couple of years, Ron and I became pretty close friends. We had certain things in common, but it certainly wasn't evident in our trading styles. He was sort of a value buyer who wasn't concerned about supply and demand or price trends. My style, in contrast, was to buy new, relatively unknown companies on the rise. I demanded that they be in a price uptrend, and if they went down much below my purchase price, I would sell them. At least that was the plan. As Ron and I watched each other's trades, our favorite sport became giving the other guy a hard time when one of his stocks tanked. Sometimes I'd hit a few losers in row and Ron would razz me. "Hey, genius, what happened? That one sure went down the toilet." The verbal jabs really got to me. Sometimes I held on to losing stocks because I couldn't stand the thought of the ridicule awaiting me when I phoned in a sell order to Ron. A stock would fall 5% and then 10%, and I knew I should sell. Then I'd think of Ron and hold on to that dog while it fell 15% and then 20%. The bigger the loss was, the harder it became to call Ron and place the sell order. Even if he didn't say a word to me, I felt humiliated. Meanwhile, the stock continued to suck money out of my account like a rupture in the hull of a ship. Both opportunities and perils surface suddenly in the market. It takes swift, resolute action to exploit one and elude the other. Nothing can unravel a trader's courage more than a huge loss in a stock trade. It wasn't until I suffered enough big losses that I made the decision that turned my performance from mediocre to stellar. I decided it was time to make money and stop stressing about my ego. I began selling off losing stocks quickly, which meant taking small losses but preserving the lion's share of my hard-earned capital. Almost overnight, I regained a feeling of control. That new approach also freed me to take an objective look at my performance. In the past, I tried to forget about my losing stocks. Now I was analyzing my losers and learning from them. I saw my portfolio with fresh eyes and finally began to understand that trading is not about picking highs and lows or proving how smart you are. Trading is about making money. If you want to reap big gains in the market, make up your mind right now that you are going to separate trading from your ego. It's more important to make money than it is to be right. Practice does not make perfect. I know people who have managed money on Wall Street for decades, yet have only mediocre results to show for it. You would think that after all those years of practice, their performance would be stellar, or at least would improve over time. Not necessarily. Practice does not make perfect. In fact, practice can make performance worse if you are practicing the wrong things. When you repeat something over and over, your brain strengthens the neural pathways that reinforce the action. The problem is that these pathways will be reinforced for incorrect actions as well as correct actions. Any pattern of action repeated continuously will eventually become habit. Therefore, practice does not make perfect. Practice only makes habitual. In other words, the fact that you've been doing something for a while doesn't mean you are guaranteed success. It could be that you're just reinforcing bad habits. I subscribe to the advice of the legendary football coach Vince Lombardi. As he said, practice does not make perfect. Only perfect practice makes perfect. In the stock market, practicing wrong will bring you the occasional success, even if you're using flawed principles. After all, you could throw darts at a list of stocks and hit a winner once in a while, but you will not generate consistent returns, and eventually you will lose. The reason most investors practice incorrectly is that they refuse to objectively analyze their results to discover where their approach is going wrong. They try to forget the losses and keep doing what they've always done. The proliferation of cheap brokerage commissions, internet trading, and web-based stock market data may have provided everyone with the same technology, but it did not grant investors an equal ability to use those resources. Just as picking up a 5-iron doesn't make you Tiger Woods, opening a brokerage account and sitting in front of a computer screen doesn't make you Peter Lynch or Warren Buffett. That's something you must work for, and it takes time and practice. What's important is that you learn how to practice correctly. Why I don't like paper trading. Do the thing and you will have the power. Ralph Waldo Emerson. As new investors learn the ropes, often they engage in paper trading to practice before putting real money at risk. Although this sounds reasonable, I am not a fan of paper trading, and I don't recommend doing it any longer than absolutely necessary until you have some money to invest. To me, paper trading is the wrong type of practice. It's like preparing for a professional boxing match by only shadow boxing. You won't know what it's like to get hit until you enter the ring with a real opponent. Paper trading does little to prepare you for when you are trading for real, and the market delivers a real punch. Because you are not used to feeling the emotional as well as the financial pressure, it will be unlikely that you will make the same decisions you did in your practice sessions. Although paper trading may help you learn your way around the market, it can also create a false sense of security and impede your performance and learning process. The psychologist Henry L. Roediger Roman III, who is the principal investigator for the Department of Psychology at Washington University in St. Louis, conducted an experiment in which students were divided into 2 groups to study a natural history text. Group A studied the text for 4 sessions. Group B studied only once but was tested on the subject 3 times. A week later, the 2 groups were tested, and Group B scored 50% higher than Group A. This demonstrates the power of actually doing the thing you're trying to accomplish versus preparing for it in simulation. If you're just starting out, you should trade with real money as soon as possible. If you're a novice trader, a good way to gain experience is to trade with an amount of money that is small enough to lose without changing your life, but large enough that losses are at least somewhat painful. Don't fool yourself into a false sense of reality. Get accustomed to trading for real, because that's what you're going to have to do to make real money. Trading is a business. Many people have the misconception that stock trading is a mysterious endeavor that is governed by a set of laws different from those for an ordinary business. Trading stocks and running a business are virtually identical. In fact, to be successful, you must trade just as if you were running a business. As an investor, your merchandise is stocks. Your objective is to buy shares that are in strong demand and sell them at a higher price. How much of a profit margin you make will depend a lot on the type of business portfolio you are running. You may be like Walmart, which operates on very small margins but does a tremendous amount of volume with high inventory turnover. Or you may be like a boutique that offers unique and trendy merchandise and earns higher margins but does much lower volume. You may be making numerous trades for a small gain, but by sheer volume, you turn in an impressive return at the end of the year. or you may be a long-term investor with select merchandise that also produces a solid return. In the end, it all comes down to having your gains on average be larger than your losses, nailing down a profit, and repeating the process. This is the basic objective of any business endeavor. Most investors treat trading as a hobby because they have a full-time job doing something else. However, if you treat trading like a business, it will pay you like a business. If you treat trading like a hobby, it will pay you like a hobby, and hobbies don't pay, they cost you. Don't invest like a fund manager. The amateur investor has many built-in advantages that could result in outperforming the experts. Rule number 1 is to stop listening to the professionals. Peter Lynch. As a stock trader in search of super performance, not only should you not listen to most professionals, you should not invest the way they do. If you're going to invest like a fund manager, why not just give your money to a fund manager? This will achieve essentially the same result without the work. Better yet, why not just invest in stock market index funds, which beat most fund managers? The fact is that to outpace their peers, most big fund managers need to learn how to invest less like fund managers and more like super performance traders. Most big funds are doomed to mediocrity by design. Individuals, however, have a big advantage over these institutional investors. Contrary to what many believe, a professional money manager has no advantage over an individual investor. Many big institutions utilize flawed principles that are based on personal opinion, tradition, and ego, as well as, in many cases, pure ignorance. The biggest handicap facing virtually every big fund manager is size. First and foremost, institutional investors need liquidity to handle the large blocks of shares they must buy to add positions that will have a meaningful impact on their portfolios. This forces big players to pick companies with relatively large amounts of shares outstanding. This is the exact opposite of what we know to be a key factor for super performance, a relatively small number of shares in the float. Big institutions have a difficult time taking a position in a company with a small number of shares outstanding. Even if they can, the real problem comes later, when it's time to sell the stock in a falling market. When forced to liquidate a large position, an institution risks precipitating a further plunge in the stock's share price as a result of the fund's large block selling activity. An individual investor, however, can move quickly and respond in an instant during both entry and exit, taking advantage of the best high-growth situations available early on, and then stepping aside when necessary. Another drawback is that many big fund managers can invest only in shares from a committee-approved list. Managers meet with these committees to justify buy and sell decisions. A dreadful situation for a manager is having to explain a position gone disastrously wrong in a small, presumably risky situation, even though the company showed great growth prospects. A safer bet with better job security is for that manager to buy larger, seemingly safe plays such as IBM and Apple. Then, if something goes wrong, the entire market most likely is suffering, and the losses can be attributed to the overall environment. At the very least, the manager's reputation is insulated by the fact that he or she bought quality. As the old Wall Street saying goes, you will never lose your job losing your client's money in IBM. Institutions generally need to stay invested in portfolios that are diversified across many individual stocks and industries. This is primarily a result of their need for liquidity and the belief that spreading risk over many names will reduce the risk in any one name. The vast majority of funds must stay at least partially invested even during dreadful market conditions. Moving to the safety of cash is frowned on. Most mutual funds never raise more than 5 or 10% cash. Managers are always being compared to benchmarks such as the S&P 500. If fund managers fall behind their benchmark averages for any length of time, investors will jump ship and the managers could lose their jobs. Individuals, in contrast, can react to surprises that create new price trends almost instantly. There is no committee approval process and no diversification mandate. With today's technology, most traders, professional and individual alike, have nearly identical tools at their disposal. However, Individual traders have a tremendous advantage over professionals mainly because they have greater liquidity and speed, enabling them to be more concentrated in a small list of well-selected names at even lower risk, because an individual can utilize stop-loss protection with little or no slippage. An individual with a faster response time can be more patient and strike at only the most opportune moments, which is the best advantage of all. Most big institutions would rather make what they regard as safe investments than pursue big capital gains. They will boast about success if the market is down 40%, but their portfolio has lost only, say, 32%. That's an example of what they claim is beating the market. If you think for a minute that the big institutional approach is safer or less risky, I suggest you take a look at your favorite mutual funds and study their performance during past major bear markets. For a big fund manager, size impairs precision, the ability to enter and exit stock positions without affecting price in a counterproductive way. This technical disadvantage forces the manager to seek informational superiority. Although tactics and techniques play a role for virtually every investor, the individual can utilize a tactical approach with far greater efficiency and effectiveness than can the large institutional player. The bottom line is that if you want mutual fund-like results, invest like a fund manager. If you want super performance results, you must invest like a super performance investor. Conventional wisdom produces conventional results. A sound banker, alas, is not one who foresees danger and avoids it, but one who, when he is ruined in a conventional and orthodox way along with his fellows, so that no one can readily blame him. John Maynard Keynes. Throughout this book you will read about findings and facts that debunk many widely accepted notions about how to succeed in the stock market. Many of these nostrums are taught by universities and fill weighty textbooks. Some of them hold up as standard references on investing. This should come as no surprise. Nothing in our society is more respectable than conventional wisdom. In my experience, attaining superperformance in stocks comes from doing things that are different from what is obvious or popular. This is often misinterpreted as risky. Applying conventional wisdom produces conventional returns, not superperformance. If success were as easy as acting like everyone else, we could become rich by mimicking the crowd. As you observe and analyze the market, be open-minded and willing to do things that most people won't do. Growth comes at the expense of comfort. Learn to venture outside your comfort zone and always question conventional wisdom. If you wish to be exceptional, you must by definition be unconventional. The unavoidable cost of success. If you want to be the best, you have to do things that other people are unwilling to do. Michael Phelps, winner of 17 Olympic medals. Ask yourself, what are my goals? Even if you haven't thought out a life plan, probably a few aspirations come to mind right away. Now ask yourself, what would I give up to achieve those goals? That's another story, isn't it? The choice to sacrifice is difficult, but it is one of the most important decisions you will make in the pursuit of success. Sacrifice means prioritizing, which could result in giving up certain activities to have the time to pursue trading. Admittedly, this is a tough step to take, but no champion has a completely balanced life when he or she is going for a gold medal. Champions are laser-focused on their goal. They understand the power of a narrow focus. This comes at a price. It's called sacrifice. To define is to sacrifice. I fear not the man that has practiced 10,000 kicks once, but I fear the man that has practiced one kick 10,000 times. Bruce Lee. Because you are reading this book, I assume that one of your goals is to become the best stock trader you can be, or at least to improve your investment results. To have any chance of real success, you will have to make some choices about how you are going to pursue that goal. Odds are that you won't be the best value trader, the best growth trader, the best day trader, and the best long-term investor. If you try to do it all, you will most likely end up a mediocre jack of all trades. You can't say that a trader is a trader any more than you can say that a doctor is a doctor. Can a physician be the best brain surgeon, the best heart surgeon, the best psychiatrist, the best pediatrician, the best rheumatologist, and the best bone specialist? Of course not. Consequently, you will enjoy market cycles when your trading style outperforms other styles, and you will also learn to accept periods less conducive to your style. I doubt you will overcome these less favorable phases by adopting a different style each time you run into difficulty. When it comes to stock trading, I know no one who, for example, can successfully trade value in one cycle and then switch to growth the next, or be a long-term investor one day and then a day trader to suit the market du jour. To become great at anything, you must be focused and must specialize. Trader or investor. The average trader spends the majority of his or her time vacillating between two emotions, indecisiveness and regret. This stems from not clearly defining one's style. The only way to combat paralyzing emotions is to have a set of rules that you operate from with clearly stated goals. You simply must make a decision. Are you a trader or an investor? Some people have a personality best suited for trading and some prefer a longer-term investment approach. You will have to decide for yourself which is best for you. Keep in mind that if you fail to define your trading, you will almost certainly experience inner conflict at key decision-making moments. Indecisiveness. Should I buy? Should I sell? Should I hold? Regret. I should have bought. I should have sold. I should have held. If you are a short-term trader, recognize that selling a stock for a quick profit only to watch it go on to double in price is of no real concern to you. You operate in a particular zone of a stock's price continuum, and someone else may operate in a totally different area of the curve. However, if you're a longer-term investor, there will be many times when you make a decent short-term gain only to give it all back in the pursuit of a larger move. The key is to focus on a particular style, which means sacrificing other styles. Once you define your style and objectives, it becomes much easier to stick to a plan and attain success. In time, you will be rewarded for your sacrifice with your own specialty. Expect some rotten days. Many of life's failures are people who did not realize how close they were to success when they gave up. Thomas Edison. The key to success is to become a successful thinker and then act on those thoughts. That doesn't mean that all your ideas and actions will always produce the desired results. At times you will feel that success is unattainable. You may even feel like giving up. I know. I've been there. I went 6 consecutive years without making a penny while pursuing stock trading. Along the way I had days when I felt so demoralized by my unsatisfactory results that I almost threw in the towel and gave up. However, I knew the power of persistence. Then, after more than a decade of trial and error, I was making more money in a single week than I dreamed of making in a year. I experienced what the English poet and playwright Robert Browning meant when he wrote, "A minute's success pays the failure of years." Remember, if you choose not to take risks to play it safe, you will never know what it feels like to accomplish your dreams. Go boldly after what you want and expect some setbacks, some disappointments, and some rotten days. Embrace them all as a valuable part of the process and learn to say, "Thank you, teacher." Be happy, feel appreciative, and celebrate when you win. Don't look back with regrets at failures. The past cannot be changed, only learned from. Most important, never let rotten days make you give up. Records are made to be broken. For many years, it was widely believed to be impossible for a human to run a mile, 1609 meters in under 4 minutes. In fact, for many years, the thinking was that the 4-minute mile was a physical barrier that no human could break without causing significant damage to the runner's health. Then on May 6, 1954, during a meet between the British AAA and Oxford University, the English athlete Roger Bannister ran a mile in 3 minutes, 59.4 seconds. Suddenly, the impossible was possible. 56 days after Bannister broke through the 4-minute barrier, the Australian champion runner John Landy ran a mile in 3 minutes and 57.9 seconds in Finland. Within 3 years, 16 other runners also cracked the 4-minute mile. What happened to the physical barrier that had prevented humans from running a mile in less than 4 minutes? Was there a sudden leap in human evolution? No, the change in thinking made the difference. Often the barriers we perceive exist only in our minds, Beliefs influence what we attempt or choose not to attempt in life. In these pages, you will learn powerful lessons and proven techniques that will make an enormous difference in what you can attain with stock trading. Records are made to be broken, mine included. If you are willing to apply yourself and learn the lessons, how can you fail? Believe you can do it. That's the first thing you need to know. Chapter 3. Specific Entry Point Analysis. The SEPA Strategy. When I began trading stocks in the early 1980s, my idea of a strategy consisted of nothing more than impulse buying of low-priced stocks that had been beaten up. When stocks were trading near their historical lows, I figured they had to be bargains. I didn't have much success with that approach. In fact, the results were downright dreadful. It wasn't long before I realized that many of these stocks were low-priced for good reason, and in most cases were on their way to lower lows. I did, however, see many stocks hit the 52-week high list and then skyrocket even higher in price. The question became, what differentiates the high flyers from the duds, and is there a way to identify the big winners before they become big winners? Over the next 5 years, 1983 to 1988, I embarked on a comprehensive research process, reading every book I could get my hands on and devouring the daily financial news. I bought books when I could afford them. What I couldn't afford to buy and take home, I stood at the bookstore shelves reading, taking notes with a pad and pencil. I would even go to the local university libraries with a pocket full of change and photocopy entire books for a penny a page, and then staple them together. Looking back, it must have been comical to see my collection of photocopied books held together by a few staples and me sitting at a fold-out card table that I used as a desk in the corner of Mother's dining room. No one in my family had a clue about what I was doing with those makeshift books. It was a modest beginning, but in the long run, it got the job done. The beginning of a turning point. The knowledge I have amassed has come not only from 3 decades of hands-on experience, but also from the study of those who arrived before me. Although I have taken the information in, refined it, and retooled it into my own specific entry point analysis, or SEPA, to suit my own trading, I am indebted to the market masters whose groundbreaking works go back many decades. An eye-opening book for me was Richard Love's Super Performance Stocks. Although much of the book was about the political cycle, I was intrigued by Chapter 7, which focused on the commonalities of big winning stocks. Love's studies, from 1962 to 1976, focused on the characteristics of stocks that went up a minimum of 300% in a 2-year period. He called them super performance stocks. Although Love's approach caught my attention, initially I wasn't sure exactly how to use it in my own trading, and so the information stayed tucked away in my mind unused while I continued my quest to learn more. In 1988, I read an article in the March-April issue of Financial Analyst Journal titled The Anatomy of a Stock Market Winner. The article discussed the findings from a study of superior securities, stocks that went up a minimum of 100% in a calendar year. The author, Mark R. Reinganem, had explored the 222 stock market winners from 1970 to 1983 to determine what contributed to their superior performance. As I read the article, the proverbial bell went off in my head, and I recalled Love's book. For one thing, there was a partial overlap between the time frames studied by Love and Reinganem. Furthermore, the purposes of their studies were almost identical, focusing on stocks that had made the biggest gains to identify the characteristics that accounted for their stellar performance. Now, all I needed was to get my hands on Love's book again, which was out of print and pretty rare. Luckily, a friend of mine found a copy in Canada at a book fair for only $1, which he bought and mailed to me. With Love's book and Reinganem's results in hand, I compared the findings of both studies and focused on the similarities between them. As I cross-referenced the two, my confidence increased that this approach, known as reverse factor modeling, had merit, and that there was a possibility I could use it in a methodical fashion to find big stock winners. It made intuitive sense to me, studying the best to find the best. Studying Love's work set me on a course to learn what makes a stock move up dramatically in price to join the elite circle of super performers. This ultimately became my life's work. Love's findings convinced me of 3 empowering points. 1. There is a right time and a wrong time to buy stocks. 2. Stocks with super performance potential are identifiable before they increase dramatically in price. 3. By correctly investing in these stocks, it is possible to build a small amount of capital into a fortune in a relatively short period. The melting pot. Over the course of my trading career, in addition to Richard Love's book, the works of others have inspired me. Among them was the relative strength concept of common stock price forecasting by Robert A. Levy, which helped me banish the buy weakness mentality and was instrumental in my new approach of focusing on strength. Then there was Edward S. Jensen's Stock Market Blueprints, published in 1967. Jensen's book included his blueprints for each type of stock, which were based on criteria such as income, growth, cyclical growth, and dynamic growth. What I liked about Jensen was that he, like Love, proceeded from an objective study of stocks to create templates from factor models. This rigorous approach inspired me to create my own leadership profile. Another influence was Richard Donkian, who was born in Hartford, Connecticut, graduated from Yale with a degree in economics, and went to work on Wall Street in the 1930s. Donkian is considered the creator of the managed futures industry. He developed a rule-based trading approach that became known as trend following. Among his principles was the buying and selling of stocks when the 5-period moving average crossed above and below the 20-period moving average. It was Donkian's work that influenced me to add certain trend elements to my model for qualifying trades and timing entries. Later I came across William L. Giler, who did extensive work in chart patterns. In his book, Giler acknowledged the contribution of Donkian, who at the time was director of commodity research at the securities firm Hayden Stone. These men became my professors as I meticulously studied the market. From Love, I learned historical precedent analysis and the commonalities of superperformance stocks. From Jensen, blueprinting and profiling. From Donkian, trend following. And from Giler, chart patterns, including his famous saucer with platform, which is now known as the cup and handle pattern, popularized by William O'Neill, who also worked at Hayden Stone in the 1960s. Of course, the master of them all was Jesse Livermore, the greatest trader ever. In 1907, he made $3 million in a single day. While most investors were devastated during the Great Crash of 1929, Livermore made a whopping $100 million shorting the market. For me, this was incredibly inspiring. Although most people associate Livermore with the book Reminiscences of a Stock Operator, I gravitated to his pragmatic work How to Trade in Stocks. Reading Livermore's book crystallized my thoughts. Many of the principles that were starting to work for me seemed no different from those that had worked for Livermore back in the first decades of the 20th century. From one market professor to the next, the lessons were consistent and clear. The basics of what made a superperformance stock in the past had not changed appreciably. No matter how the economy evolved or which industries emerged, the basic criteria for superperformance were constant. Many people before me had come to the same conclusion. Although the names differed, and each had his or her own tactics for exploiting this phenomenon, a collective body of knowledge existed and waited for new explorers to build on that foundation. At last, technology. By the late 1980s, I bought my first powerful computer. By that I mean a machine I could use for something other than playing tennis pong on a monochrome green screen. In addition to putting real-time quotes right on my desk, the computer allowed me to create a database and gave me access to more information. Now, I could conduct quantitative analysis, tracking and studying more big winners and observing stocks in real time to confirm historical findings in a modern time frame. The computer also allowed me to screen thousands of potential companies on the basis of superperformance characteristics. Before this, I was finding and tracking stocks manually, which, as you might guess, placed a severe limitation on how many I could cover. Early on, I even created my stock charts by hand on graph paper daily. What a chore! As I studied and traded stocks in real time, the data I collected and the results I produced agreed with Love and Reinganum's conclusions. Up to this point, I had not developed a specific formula for trading, but I was homing in on the characteristics of superperformance stocks and starting to have some meaningful success by trading on those insights for my own account. Putting the findings to work. The boom in technology, consumer retailing, and healthcare in the early 1990s transformed obscure companies into household names. Utilizing what I had learned during the 1980s, I was able to catch some big movers as stocks transitioned from the 1990 bear market into a new bull market. U.S. Surgical, Amgen, American Power Conversion, Ballard Medical Products, U.S. Healthcare, Surgical Care Affiliates, Medco Containment, Microsoft, Home Depot, Dell Computer, International Game Technology, and Cisco Systems were at that time relatively unknown names that displayed strong fundamental and technical characteristics. Many investors missed these great companies during their phenomenal growth phases because of their relatively high price and earnings P/E ratios. In 1991, the 40 top-performing stocks, starting at above $12 a share, began the year with an average P/E of 29, and by year-end, their P/E ratios had expanded to 83. The leadership profile. By using almost 3 decades of actual trading and meticulous accumulation of historical data from as far back as the late 1800s, I've constructed a blueprint of the characteristics shared by super-performance stocks. I call this a leadership profile, which is an ongoing effort to identify in detail the qualities and attributes of the most successful stocks of the past to determine what makes a stock likely to dramatically outperform its peers in the future. The focus is not just on the magnitude of a price move, how much a stock goes up, but also on the time element of the equation, how fast it goes up and what accounts for the rapid rise. In the stock market, timing is crucial because time is money. When screening my database, I compare each stock candidate to how well it fits the optimal leadership profile and rank it accordingly. The result is a dramatic increase in the probability of finding the next superperformer. SEPA, a strategy of precision. Honing my timing for entries and exits has been a major focus for me. Over the years, my SEPA methodology evolved into a strategy that has been referred to by some as trading with surgical precision. The SEPA approach, which I will explain in detail, allows me to find those elite candidates that have the potential to become superperformers. The objective of SEPA is to take all the pertinent information available and pinpoint the precise spot at which to enter a high-probability trade in terms of risk versus reward. SEPA combines corporate fundamentals with the technical behavior of a stock. The underlying criteria of SEPA are derived from rigorous research, decades of application in the real world, and observed facts, not personal opinions or academic theories. The 5 key elements of SEPA. The basic characteristics are broken down into 5 major categories, which make up the key foundational building blocks of the SEPA methodology. 1. Trend. Virtually every superperformance phase in big, winning stocks occurred while the stock price was in a definite price uptrend. In almost every case, the trend was identifiable early in the superperformance advance. 2. Fundamentals. Most superperformance phases are driven by an improvement in earnings, revenue, and margins. This typically materializes before the start of the superperformance phase. In most cases, earnings and sales are on the table and measurable early on. During a stock superperformance phase, a material improvement almost always occurs in the fundamental picture with regard to sales, margins, and, ultimately, earnings. 3. Catalyst. Every stock that makes a huge gain has a catalyst behind it. The catalyst may not always be apparent upon a casual glance, but a little detective work on the company's story could tip you off to a stock with superperformance potential. A new hot-selling product that accounts for a meaningful portion of a company's sales may provide the spark to ignite a superperformance phase in that company's stock price. Approval by the FDA, a newly awarded contract, or even a new CEO can bring life to a previously dormant stock. In dealing with small, lesser-known names, it often takes some event to attract attention to a stock. I like to see something that gets investors excited. Examples would include Apple reaching cult status with its Mac and i products, Research in Motion RIM with its BlackBerry, so habit-forming for internet and email junkies that it's been nicknamed Crackberry, and Google Goog, which became so synonymous with internet search engines that it made it into the dictionary as a verb. Each situation may be somewhat different, whether the stock is a classic growth company, a turnaround situation, a cyclical stock, or a biotech trading on the promise of a new drug. Whatever the reason, behind all superperformance, there is always a catalyst driving institutional interest. 4. Entry points. Most superperformance stocks give you at least one opportunity, and sometimes multiple opportunities, to catch a meteoric rise at a low-risk entry point. Timing the entry point is critical. Time your entry incorrectly and you will be stopped out unnecessarily or lose big if the stock turns around and you fail to sell. Time the entry correctly during a bull market and you could be at a profit right away and on your way to a big gain. 5. Exit points. Not all stocks that display superperformance characteristics will result in gains. Many will not work out even if you place your buys at the correct point. This is why you must establish stop-loss points to force you out of losing positions to protect your account. Conversely, at some point your stock must be sold to realize a profit. The end of what once was a superperformance phase needs to be identified to keep what you've made. The SEPA ranking process can be summarized as follows. 1. Stocks must first meet my trend template, see Chapter 5, to be considered a potential SEPA candidate. 2. Stocks that meet the trend template are then screened through a series of filters that are based on earnings, sales and margin growth, relative strength, and price volatility. Approximately 95% of all stocks that qualify under the trend template fail to pass through this screen. 3. The remaining stocks are scrutinized for similarities to my leadership profile to determine whether they are in line with specific fundamental and technical factors exhibited by historical models of past superperformers. This stage removes most of the remaining companies, leaving a much narrower list of investment ideas for an even closer review and evaluation. 4. The final stage is a manual review. A narrowed list of candidates is examined individually and scored according to a relative prioritizing ranking process that takes into consideration the following characteristics: reported earnings and sales. Earnings and sales surprise history. Earnings per share EPS growth and acceleration. Revenue growth and acceleration. Company issued guidance. Revisions of analysts' earnings estimates. Profit margins. Industry and market position. Potential catalysts, new products and services or industry or company-specific developments, performance compared with other stocks in same sector, price and trading volume analysis, liquidity risk. The SEPA ranking process is focused on identifying the potential for the following. 1. Future earnings and sales surprises and positive estimate revisions. 2. Institutional volume support, significant buying demand. 3. Rapid price appreciation based on a supply and demand imbalance, lack of selling versus buying. Probability convergence. I developed SEPA to identify precisely the point at which I can place a trade to have the lowest risk and the highest potential for reward. My goal is to purchase a stock and be at a profit immediately. To accomplish this, I take into account all the relevant fundamental, technical, and market factors and pinpoint the position at which there is a supportive convergence. I execute a trade only at the point of alignment across the spectrum with regard to company fundamentals, stock price, and volume activity as well as overall market conditions. I want to see these factors converge like four cars arriving at the same time at a four-way intersection. The SEPA method stacks supporting probabilities to produce that alignment. Virtually every big winning stock exhibits very specific and measurable criteria before making its big moves. In their super performance days, these stocks have distinguishing characteristics, whether a new product, an innovative service, or some kind of fundamental change, that enables the company to make money at a superior or accelerated rate, and in some cases for an extended period. As a result, the shares of these companies experience significant price appreciation by attracting institutional buying. You don't have to know everything about a company or the market. However, you need to know the right things. By putting all these elements together, fundamental, technical, qualitative, and market tone, and demanding that stocks be able to cross multiple hurdles, you will be far more likely to identify something exceptional. The collective value of these parameters is greater than the sum of their parts. Super performance traits. Over the years, I've concluded that most super performance stocks have common identifiable characteristics. In the majority of cases, decent earnings were already on the table. In fact, the majority of super performance stocks already had periods of outperformance in terms of fundamentals as well as technical action before they made their biggest gains. More than 90% of super performance stocks began their phenomenal price surges as the general market came out of a correction or bear market. Interestingly, very few stocks had super performance phases during a bear market. Super performers are youthful. Generally, a super performance phase occurs when a stock is relatively young, for example, during the first 10 years after the initial public offering IPO. Many super performers were private companies for many years before going public, and when they finally did, they had a proven track record of earnings and growth. Some super performance companies already established successful product lines and brands before coming public. During the bear market correction of the early 1990s, I focused on stocks that were holding up well and then moved into new high ground first off the market's low. Most of the names I traded were relatively unknown at the time. These stocks were propelled by characteristics such as big earnings growth and strong product demand. One example was U.S. Surgical, which pioneered products such as the surgical staple and laparoscopic surgery. Software, computer peripheral, and technology-related stocks also performed well during that period, fueled by the boom in personal computing. Most investors shy away from names they have never heard of. This is exactly the opposite of what you should do if your goal is to find big stock market winners. Size matters. Most companies have their high growth phase when they're relatively small and nimble. As they grow older, larger, and more mature, their growth begins to slow, as does the rate at which their stock prices appreciate. Super performance stocks are often small cap companies, although occasionally a big cap name could see a surge in price after a turnaround or a period of depressed stock prices resulting from a bear market. Most of the time, however, it is a small cap or a mid-cap stock that hits a period of accelerated growth, which in turn creates a super performance price phase. Investors interested in super performance should keep a constant lookout for small to medium-sized companies in the growth stage of their life cycle, accelerating earning and sales. On balance, the growth of earnings and sales, and more important, the stock price is usually more rapid for a small to medium-sized company than for a larger, mature company. Large companies usually have proven track records of execution. With smaller companies, it's important in most cases to confirm that they are already profitable and have proved that their business model can be scaled and duplicated. Look for candidates with a relatively small total market capitalization and amount of shares outstanding. All things being equal, a small-cap company will have the potential to appreciate more than a large cap based on the supply of stock available. It will take far less demand to move the stock of a small company with a comparatively small share float than a large cap candidate. This realization can also help you develop realistic expectations about the profit side of the equation. Large cap companies are not going to make large-scale price advances the way a younger, smaller company will. There are times when a big cap stock will be depressed because of a bear market or a temporary economic hardship, which may provide the opportunity to buy a company such as Coca-Cola or American Express or Walmart at the beginning of a decent price move as it recovers. Generally speaking, though, if a large cap company advances rapidly in a short period, I'm inclined to take profits on it more quickly than I would with a smaller, faster-growing company that may have the potential to double or even triple in a number of months. Stock screening. Since the 1980s, I have been using computer-assisted screening as a way to narrow down a tremendous amount of information, as many as 10,000 stocks daily, to produce a manageable list of candidates that meet some minimum criteria to be studied further. Today, there are many screening tools available for the investor. Here are a few suggestions on screening. When you are conducting quantitative analysis, stock screening. Keeping it simple will serve you better than using a complicated model. You must be careful not to put too much into each screen. Otherwise, you may inadvertently eliminate good candidates that meet all your criteria except for one. For example, let's say you want to select stocks that exhibit a certain level of earnings, market cap, estimate revisions, and so forth, until you have 12 lines of criteria. If a stock meets 11 but misses by a hair on the 12th, you will never see that stock. Remember, if you have 100 items in your criteria, a stock needs to miss only one to be filtered out even though the other 99 are met. A better approach is to run separate screens that are based on smaller lists of compatible criteria. For example, one screen for relative price strength and trend, and a separate fundamental screen that is based on earnings and sales. Often, as you run isolated screens, you will see some of the same names recurring, whereas a few names will appear on only one list. Remember, computers are great for weeding out noise and pointing your research in the right direction. However, if you want consistent super performance, you will need to roll up your sleeves and do some old-fashioned manual analysis. That's the interesting part of trading, and that's what makes it fun and rewarding. Make a commitment to an approach. You don't need a PhD in math or physics to be successful in the stock market, just the right knowledge, a good work ethic, and discipline. The SEPA methodology was developed after decades of searching, testing, and going back to the drawing board countless times to uncover what actually works. It has been time-tested and proved effective in the real world with real results. You, too, will go through your own trial and error period, window shopping and trying various concepts and approaches to the stock market, whether value, growth, fundamental, technical, or some combination. In the end, to succeed, you will need to settle on an approach that makes sense to you. Most important, you must commit to perfecting and refining your understanding of that methodology and its execution. A stock trading strategy is like a marriage. If you're not faithful, you probably won't have a good outcome. It takes time and dedication, but your objective should be to become a specialist in your approach to the market. Although strategy is important, it's not as critical as knowledge and the discipline to apply and adhere to your rules. A trader who really knows the strengths and weaknesses of his or her strategy can do significantly better than someone who knows only a little about a superior strategy. Of course, the ideal situation would be to know a lot about a great strategy. That should be your ultimate goal. Chapter 4. Value comes at a price. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Warren Buffett. When you think of value in the traditional sense, bargains immediately spring to mind. Something once priced higher now is priced lower. It seems logical. Growth stock investing, however, can turn this definition on its head. In the stock market, what appears cheap could actually be expensive, and what looks expensive or too high may turn out to be the next super performance stock. The simple reality is that value comes at a price. The P/E ratio, overused and misunderstood. Every day, armies of analysts and Wall Street pros churn out thousands of opinions about stock values. This stock is overvalued. That one is a bargain. What is the basis of many of these valuation calls? Often it's the price and earnings ratio, P/E, a stock's price expressed as a multiple of the company's earnings. A great amount of incorrect information has been written about the P/E ratio. Many investors rely too heavily on this popular formula because of a misunderstanding or a lack of knowledge. Although it may come as a surprise to you, historical analyses of superperformance stocks suggest that by themselves P/E ratios rank among of the most useless statistics on Wall Street. The standard P/E ratio reflects historical results and does not take into account the most important element for stock price appreciation, the future. Sure, it's possible to use earnings estimates to calculate a forward-looking P/E ratio, but if you do, you're relying on estimates that are opinions and often turn out to be wrong. If a company reports disappointing earnings that fail to meet or beat the estimates, analysts will revise their earnings projections downward. As a result, the forward-looking denominator, the E in P/E, will shrink, and assuming the P remains constant, the ratio will rise. This is why it's important to concentrate on companies that are reporting strong earnings, which then trigger upward revisions in earnings estimates. Strong earnings growth will make a stock a better value. Bottom fisher's bliss. Some analysts will recommend that you buy a stock that has had a severe decline. The justification may be that the P/E is at or near the low end of its historical range. In many instances, however, such price adjustments anticipate poor earnings reports. When quarterly results are finally released and a company misses analysts' estimates or reports a loss, the P/E moves back up. In some cases it skyrockets, which may cause the stock price to adjust downward even further. This was the case for Morgan Stanley, MS, and NYSE in late 2007. The stock price fell and drove the P/E to a 10-year low. Morgan later reported disappointing negative year-over-year earnings comparisons, and the P/E ratio promptly soared to more than 120 times earnings. With earnings deteriorating and the stock selling at a P/E of 120, the stock was suddenly severely overvalued. The share price plunged even further to under $7. The cause of Morgan Stanley's decline was an industry-wide financial crisis, and by 2008, the P/E ratios of Bank America, Citigroup, and AIG all hit 10-year lows, along with those of many others in the banking and financial sector. Within 12 months, all three stocks plunged more than 90%. The cheap trap. Buying a cheap stock is like a trap hand in poker. It's hard to get away from. When you buy a stock solely because it's cheap, it's difficult to sell if it moves against you because then it's even cheaper, which is the reason you bought it in the first place. The cheaper it gets, the more attractive it becomes based on the "it's cheap" rationale. This is the type of thinking that gets investors in big trouble. Most investors look for bargains instead of looking for leaders, and more often than not they get what they pay for. Don't pass on high P/E stocks. It is normal for growth stocks to fetch a premium to the market. This is especially true if a company is increasing its earnings rapidly. Shares of fast-growing companies can trade at multiples of 3 or 4 times the overall market. In fact, high growth leaders can command even higher premiums in times when growth stocks are in favor relative to value stocks. Even during periods when growth is not in favor, they can sell at a significant premium to the market. In many cases, stocks with superperformance potential will sell at what appears to be an unreasonably high P/E ratio. This scares away many amateur investors. When the growth rate of a company is extremely high, traditional valuation measures based on the P/E are of little help in determining overvaluation. However, stocks with high P/E ratios should be studied and considered as potential purchases, particularly if you find that something new and exciting is going on with the company, and there's a catalyst that can lead to explosive earnings growth. It's even better is if the company or its business is misunderstood or underfollowed by analysts. Internet providers were a great example. When Yahoo was at the forefront of one of the greatest technological changes since the telephone, I was asked in a television interview if I thought the internet would survive. Can you imagine the internet failing to exist? Not today. But in the early to middle 1990s, you might have had a different view, as many did. That period was precisely when internet technology stocks were making new 52-week highs and trading at what appeared to be absurd valuations. Most of the best growth stocks seldom trade at a low P/E ratio. In fact, many of the biggest winning stocks in history traded at more than 30 or 40 times earnings before they experienced their largest advance. It only makes sense that faster-growing companies sell at higher multiples than slower-growing companies. If you avoid stocks just because the P/E or share price seems too high, you will miss out on many of the biggest market movers. The really exciting, fast-growing companies with big potential are not going to be found in the bargain bin. You don't find top-notch merchandise at the dollar store. As a matter of fact, the really great companies are almost always going to appear expensive, and that's precisely why most investors miss out. High growth baffles the analysts. You might recall when Mark was here last in mid-October 1998, he recommended Yahoo, which is up 100% since then. Ron Insana, CNBC interview, November 1998. Wall Street has little idea what P/E ratio to put on companies growing at huge rates. It's extremely difficult, if not impossible, to predict how long a growth phase will last and what level of deceleration will occur over a particular time frame when one is dealing with a dynamic new leader or new industry. Many superperformance stocks tend to move to extreme valuations and leave analysts in awe, as their prices continue to climb into the stratosphere, in spite of what appears to be a ridiculous valuation. Missing out on these great companies is due to misunderstanding the way Wall Street works and therefore concentrating on the wrong price drivers. In June 1997, I bought shares of Yahoo when the stock was trading at 938 times earnings. Talk about a high P/E. Every institutional investor I mentioned the stock to said, "No way, Yahoo." The company was virtually unknown at the time, but Yahoo was leading a new technological revolution, the Internet. The potential for what was then a new industry was widely misunderstood at the time. Yahoo shares advanced an amazing 7,800% in just 29 months, and the P/E expanded to more than 1,700 times earnings. Even if you got only a piece of that advance, you could have made a boatload. What's high? What's low? Jan 9 Minervini bought Tasser Nasdaq, a company that makes taser guns, non-lethal weapons for police departments. He spotted its potential using his proprietary methodology, specific entry point analysis, SEPA. He then rode the stock up 121% in only 6 weeks. Business Week Online, May 10, 2004. Everybody knows the old adage, buy low and sell high. It makes sense, like going to a store to find something on sale. However, buying low and selling high has little to do with the current stock price. How high or low the price is relative to where it was previously is not the determining factor in whether a stock will go higher still. A stock trading at $60 can go to $260, just as a stock trading at $2 can go to $1 or even to $0. Was Yahoo too high when it boasted a P/E ratio of 938? How about Tasser, and Nasdaq in January 2004, just before it advanced 300% in 3 months? Was it too high trading at a P/E ratio of more than 200 times earnings? Conversely, AIG appeared to be a bargain when its P/E hit a 10-year low in early 2008. The stock fell 99% before the year was finished. There's a reason a Ferrari costs more than a Hyundai. If you want to buy a high-performance car such as a Ferrari, you're going to pay a premium price. The same thing applies to high-performance stocks. The top 100 best-performing small and mid-cap stocks of 1996 and 1997 had an average P/E of 40. Their P/Es grew further to an average of 87 and a median of 65. Relatively speaking, their initially expensive P/Es turned out to be extremely cheap. These top stocks averaged a gain of 421% from buy point to peak. The P/E of the S&P 500 ranged from 18 to 20 during that period. On October 13, 1995, CKR emerged into new high ground trading at a 55x earnings. From the point, CKR emerged into new high ground on October 13, 1995. The stock advanced more than 400% in 28 months, but the P/E ratio fell because earnings grew even faster. Value investors often shy away from stocks with high price and earnings multiples. They won't touch a stock whose P/E is much higher than, say, that of the S&P 500 index. Savvy growth players know that you often have to pay more for the best goods in the market. Consider the example of CKE Restaurants, which sported a relatively high P/E just before the stock price took off. CKE Restaurants emerged into new high ground in extremely fast trading on October 13, 1995. Right before its breakout, the stock had a P/E of 55, or 2.9 times the S&P P/E of 18.9. The company had scored triple-digit profit growth in the 2 most recent quarters. Analysts saw the operator of Carl's Jr. burger shops increasing profit by a whopping 700% from year-ago levels in the upcoming quarter. The stock climbed for 103 weeks. It finally peaked near $41 in October 1997 for a 412% gain. During its price advance, CKE averaged a spectacular 175% growth in earnings from 1995 to 1997. Its P/E fell to 47, or 1.8 times the P/E of the S&P. Apollo Group, APOL. Most of the time money in stocks is lost not because the P/E was too high but because earnings did not grow at a high enough rate to sustain expectations. The growth potential of the company was misjudged. The ideal situation is to find a company whose growth prospects warrant a high P/E, a company that can deliver the goods, and the longer it can maintain strong growth, the better. Consider the example of Apollo Group. From mid-2001 through 2004, the P/E ratio for Apollo was virtually unchanged despite a 200% rally in the price of the stock. Why did the P/E remain at the same level as it was several years earlier, even though the stock price soared? Because earnings kept pace with the stock's price appreciation. If a company can deliver strong earnings as fast as or even faster than its stock price appreciates, an initial high valuation may prove to be very cheap. Apollo Group went public in December 1994 with a market value of only $112 million. Apollo met or beat Wall Street estimates for 45 consecutive quarters. As you can probably imagine, this led the company's stock price to superperformance status. In 2001, Apollo was trading at 60x earnings. By 2004, the price advanced 200%, but the P/E ratio remained at 60x due to earnings growth keeping pace. From 2000 to 2004, Apollo Group stock advanced more than 850%. During the same period, the Nasdaq Composite Index was down 60%. Crocs mania. As the plastic clogs originally meant for gardeners and boaters became a fashion rage, everybody started wearing Crocs, and the popularity spilled over into the stock. Crocs and Nasdaq shares boasted a P/E of more than 60 times earnings before the price blasted higher. But fads come and fads go, and perhaps the world is finding that, when it comes to Crocs, the shoe no longer fits. The P/E ratio for Crocs contracted from April 2006 to October 2007, as earnings grew faster than the stock's price appreciation. If you had bought Crocs when shares were trading at more than 60x earnings, the most expensive P/E in its history, you could have reaped a return of 700% on your money in only 20 months. If you had waited for the stock to trade at a more reasonable valuation and bought when the stock traded near its historical low P/E, you would have lost 99% of your capital in less than a year. Regardless of one's opinion, the market always has the last word. Value doesn't move stock prices, people do. Many people get confused. They think we are trading the actual companies themselves, that the pieces of paper we are trading, investing, owning, are some sort of redemptive right, a coupon that will give you certain cents off, or an ownership right that will allow you to have a chunk of the brick and mortar if not the cash in the treasury of the joint. Untrue. These are, in the end, simply pieces of paper to be bought, sold, or manipulated up and down by those with more capital than others. The fundamentals of the company play only a part in what moves the stock up or down. Jim Cramer. Contrary to what many believe, the stock market doesn't trade on the basis of objective, mathematical measures of intrinsic value, such as P/E ratios or a stock's price-to-book ratio. If that were the case, slavish devotion to computer models would consistently pump out winners and fund managers would regularly beat the market averages. If analyzing balance sheets were the holy grail for stock investing, accountants would be the world's greatest traders. Neither is the case. There is no magic formula or mechanistic model that can reliably generate excess returns in perpetuity. Everything is relative, subjective, and dynamic. Valuation methods that work wonderfully during certain market conditions will fail miserably during others. Every stock carries a growth assumption, which constantly changes. These assumptions are in large part constructed and based on personal opinion. Stock prices move on the basis of what people think. Whether it's an opinion about a balance sheet, the company's assets, a hot new product, an exciting new industry, the P/E ratio, the book value, future growth prospects, or whatever, ultimately it's perception that motivates investors and creates price movement. Value doesn't move stock prices. People do by placing buy orders. Value is only part of the equation. Ultimately, you need demand. Only the perception of value can influence people to buy, not the mere reading of a valuation metric. Without a willing buyer, stocks of even the highest quality companies are worthless pieces of paper. The sooner you realize this, the better off you will be as a speculator. In Search of Value. In 1987, Irises, a painting by Vincent van Gogh, sold for $49 million, a world record for a work of art. The painting changed hands at a price more than double what it had been expected to reach. The sale was also accomplished in what may have been record time in light of the figures involved. The bidding rose from a starting point of $15 million to reach the final sale price in less than 2 minutes. Analysts and investors search continually for some intrinsic value that differs from a stock's current market price. Often that quest boils down to relating a stock's price to its earnings. Concluding that a stock is overvalued because it sells for 65 times earnings is like saying that a Van Gogh painting selling at $49 million at auction is overvalued because the paint and canvas cost only $40. The price of a Van Gogh has nothing to do with its intrinsic value. The painting sells on the basis of its perceived value, which is directly affected by the demand for a one-of-a-kind piece of art. Wall Street commonly uses 2 measures for valuing stocks. One method involves comparing a stock's P/E ratio with that of its respective industry group, or that of the overall market S&P 500 index, etc. Often this leads to mistaken conclusions that laggard stocks are of value and market leaders are overpriced. More often than not, the market leader that appears expensive actually turns out to be cheaper in the long run than the lower P/E, poorer performing stocks in the group. The other method is to compare a stock's P/E with its own historical range for a certain period. The argument goes that if the P/E is near the low end of its range or below the P/E of its industry group or the market in general, the stock must be cheap. The stock may look cheap, but the market may be marking down the merchandise for a good reason. Indeed, that discount might presage wholesale write-offs. If tomorrow the price of a stock you own fell 25% from your purchase price, would you feel better knowing that the P/E had fallen below its industry average? Of course not. You should be asking yourself, do the sellers know something I don't? Stocks adjust to new circumstances every day, yet many investors keep holding their declining shares because they consider the stock to be a bargain. Some advisors will even tell you to buy more shares, throwing good money after bad. Meanwhile, your stock continues to get clobbered and you keep losing money. Some of the best value investors were down 60% or more in the bear market that started in 2007. Their experience of buying and holding solid companies, which had worked so well for so long, led to complacent behavior that resulted in large losses. In 2008, the overall market suffered heavy losses, with the value line geometric index finishing the year down 48.7%. The Dow was down 34% for the year. However, the worst performing value line categories were low price to sales, down 66.9%, low price to book value, down 68.8%, and low P/E ratio, down 70.9%. The bottom line, value investing does not protect you. No magic number. As history has shown, there is no common denominator or appropriate level when it comes to a P/E ratio and superperformance stocks. The P/E can start out relatively low or high. My suggestion is to forget this metric and seek out companies with the greatest potential for earnings growth. Most of the time, a true market leader is a much better value than a laggard despite its higher P/E multiple. Crossing a stock off your list because its P/E seems too high will result in your missing out on what, could be the next great stock market winner. The 25 top-performing stocks from 1995 to 2005 had an average P/E ratio of 33x, ranging from a low of 8.6x to a high of 223x. The three best performers in the group, American Eagle Outfitters, Penn National Gaming, and Celgene, sported P/E ratios of 29x, 11x, and 223x respectively before they made their big price advances. All three saw their stock prices rise at a 40% or better compounded annual growth rate over the 10-year period. In early 1995, CKE Restaurants traded at a relatively high P/E ratio before staging a massive rally, and then at a relatively low P/E before experiencing a major decline. Warning: the super low P/E. One of the worst trades I ever made was Bethlehem Steel trading at 2x earnings. I said, how low can it go? It went to 0. Jim Cramer. Although I don't concern myself too much with the P/E ratio in my search for super-performance stocks, there is one situation that gets my attention. As a rule of thumb, I'm very reluctant to buy shares of a company trading at an excessively low P/E, especially if the stock is at or near a 52-week low in price. A stock with an exceptionally low P/E ratio can turn out to be real trouble. A stock trading at a multiple of 3, 4, or 5 times earnings, or at a number far below the prevailing industry multiple, could have a fundamental problem. The future prospects of the company may be questionable. Earnings could be headed much lower. The company might even be headed toward bankruptcy. Remember, the market is a discounting mechanism that trades on the future, not the past. Just as you can't drive a car by looking only in the rearview mirror, you shouldn't run a stock portfolio on backward referencing valuation metrics. I would rather own a stock that's reporting strong earnings trading at a relatively high P/E ratio than a stock showing signs of trouble trading at a very low P/E. P/E deception. If you compare a stock's share price with its P/E ratio, often you will see that a depressed P/E coincides with a depressed stock price and vice versa. The same could be said about an overbought and oversold technical indicator such as the stochastic oscillator. On the surface, both of these popular metrics appear to have a degree of accuracy at turning points because the eye is drawn to peaks and troughs. However, this 20 and 20 vision is usually a gift of hindsight. In real time, the eye is not very good at filtering out all the noise and static between the upturns and downturns. In addition, what is mostly ignored or misunderstood is the varying time frame spent in the direction of the countertrend reading. For example, one stock can remain overvalued for months, whereas another stock can remain at a similar valuation for years before a change in direction takes place. Trying to buy oversold conditions and sell overbought conditions as a trading strategy is risky business. Trading with disregard for a strong directional trend will ultimately lead to buying into a precipitous decline. Similarly, buying stocks simply because the P/E is relatively low and selling because the P/E seems too high produces poor results time and time again. Although overbought and oversold conditions as well as high and low P/Es can exist at turning points, stocks can also have extreme high and low readings in a directional fashion just before major advances and declines. Major market declines always plunge to deeply oversold readings, and roaring bull markets storm through early overbought conditions while advancing much farther. The broken leader syndrome. A common affliction among many investors, including some professionals, is what I call the broken leader syndrome. Here's how it works. Investors who refuse to buy a dynamic new leader when it was emerging, before it skyrocketed, become interested after that stock has topped and broken down in price. Usually this occurs during a stage 4 decline. These people buy stocks that were previously expensive, thinking they will go back up. The broken leader syndrome affects investors who weren't able to spot stocks such as Yahoo, Amazon, and Apollo Group before their biggest price moves. They weren't on board when one of these incredible stocks made a huge run of several thousand %. Then the stock gets slammed. Now these investors think they are onto something. With a former high flyer well off its peak, these latecomers to the party think the stock looks good and is now a bargain. They use all sorts of reasons, such as it's trading near the low end of its historic range and it's trading at only 20 times earnings and has a growth rate of 40%. Worse yet, they'll say, it's down 70%. How low can it go? With all their rationalizing, they ignore the supreme fundamental, the market's judgment. They stayed away when the stock was a market leader, probably because it looked expensive, and now they fail to recognize a broken leader. When a leader tops, more often than not the stock price is discounting a future slowdown in growth, which makes it no bargain at all. Sun Microsystems is a good example of a broken leader play. The stock had an incredible price advance during the 1990s and then topped out in late 2000. Investors who were waiting for this powerhouse to correct, or come in, so that they could buy it may have been elated to see the stock off 75% from its high in 2001. Unfortunately, the party was over, and a year later Sun's stock fell a further 80%. 8 years later, investors who bought the stock at the discounted 75% off price not only didn't make money, they actually lost 99% of their capital. Here's a common misperception when a stock has a precipitous drop. A stock that falls from $100 to $25 has declined by 75%. Since a stock can drop only 100%, the thinking is that the risk is only an additional 25%, right? Wrong. If you buy the stock at $25, you could lose another 75% if it falls to $6.26. And if you buy it at $6.26, you could lose yet another 75% if it falls to $1.56. After all, your money in the stock is always 100%. P/E ratio is a barometer of sentiment. By themselves, P/E ratios aren't very helpful in determining the potential direction of a stock's price. The P/E ratio tells you what the market is willing to pay for a company's earnings at the current time. Think of the P/E as a barometer that measures the level of expectation. This is why many growth stocks experience P/E expansion during the growth phase. Expectations keep getting higher as the company's performance expands. Of course, there comes a time when the stock's prospects darken and business conditions change. The company may then be considered overvalued. At that point, perceptions change and the stock price will adjust to reflect the new set of circumstances. I use the P/E ratio as a sentiment gauge that gives me some perspective about investor expectation. Generally speaking, a high P/E means there are high expectations, and a low P/E means there are lower expectations. Seek out companies with the greatest potential for earnings growth. Companies growing revenues at a rapid pace are your best choice. Look for new emerging trends that can translate into mass expansion, trends that are scalable. Concentrate on entrepreneurially managed companies with exciting things going on, a catalyst, and you'll eventually latch on to some big winners. The current P/E ratio at which a company trades is only a minor consideration compared with the potential for earnings growth. Growth stocks are driven by growth. The PEG ratio. The price and earnings to growth PEG ratio is calculated by dividing the P/E multiple by a company's projected earnings per share growth rate over the next year. For example, if a stock is trading at 20 times earnings and has a growth rate of 40%, the PEG ratio will be 0.52040. The company is trading at half its growth rate. The theory is that if the resulting value is less than 1, the stock may be undervalued. If the PEG ratio is over 1, the stock may be overvalued. The farther the value is from 1, the stronger the signal is. In general, if a company's earnings growth rate matches or exceeds its P/E multiple, investors using the PEG ratio for valuation may consider the stock fairly valued or even undervalued. If the P/E multiple significantly exceeds its growth rate, however, the stock will be considered risky and overvalued according to this school of thought. Many analysts intent on buying growth at a reasonable price, GARP, Use PEG ratios in various forms. The point at which a stock is deemed undervalued or overvalued can vary, depending on the analyst. Some investors look to pair their holdings in a stock as soon as its price multiple exceeds its growth rate by any margin. Like its P/E cousin, the PEG ratio can exclude some of the most dynamic and profitable companies from a candidate buy list. The PEG ratio is limiting on the two sides of the equation that are most valuable when a stock has an exceptionally high or low P/E. Should a stock with a growth rate of 2% trade at 2 times earnings? Probably not. However, valuing a high-technology stock such as Yahoo, which traded at 938 times earnings, was nearly impossible using traditional valuation measures. Another drawback of the PEG ratio, as I see it, is that many of the broken leader plays are attractive with this method. This can entice you to buy into a stock that has put in a major top and headed for negative surprises. Gauging P/E expansion. Because P/E is a ratio, its value will be affected if either the numerator or the denominator changes. For example, the P/E will expand if a stock's price, numerator, rises faster than the company's earnings, denominator. Both numbers, however, can be moving targets, particularly when a company has good potential for increasing its earnings and also is attracting buyers who are accumulating the stock, which pushes the price higher. To illustrate, let's say company A is trading at 25 times its earnings for a P/E of 25. If it reports earnings that are 20% higher and the stock price remains essentially unchanged, the P/E will drop to 20.83 times earnings. If the stock price jumps 20% on the earnings news, the P/E will remain the same at 25 times earnings. Over time, as a stock grows more and more popular and the price rises consistently, its P/E ratio can expand as the stock's price appreciates at a faster rate than its earnings growth. If the stock rises significantly over 12 to 24 months and the P/E expands by 100 to 200%, doubling or tripling from where it started near the beginning or from the bottom of the major price move, it's possible that the price move is in its later stage and is getting too widely recognized. Historical study of super-performance stocks shows that the average P/E increased between 100 and 200% on average, or 2 to 3 times from the beginning until the end of major price moves. This information can be used in two ways. First, you can get an idea of a stock's potential. You can estimate what it might sell for as an average best-case scenario within a year or two down the road from your initial purchase price. That is, if you're buying a dynamic leader in a bull market. You could estimate future earnings and apply the expanded P/E number to get a rough idea of the stock's theoretical potential. Second, you can gain some perspective on how much of the company's good fortune has already been discounted by gauging how much P/E expansion has taken place already. Let's say you buy a stock with a P/E of 20 at its initial breakout from a sound base. Multiply 20 by 2 to 3 to see what the ratio could rise to. That gives you 40 to 60. You hope that the stock continues to rally. Though it's always prudent to look for sell signals, pay extra attention once the P/E nears 2 and especially around 2.5 to 3 or greater. It could top soon afterward. If this occurs, look for signs of decelerating growth and signs of weakness in the stock price as your signal to reduce your position or sell it out. In the 1990s, as Home Depot stock became an institutional favorite, rampant enthusiasm ran the stock price up well ahead of its earnings growth. Home Depot's P/E expanded from the mid-20s to 70x earnings in just 2 years after the stock bottomed from its 1990 bear market low. A period of sideways consolidation took place for the next 4 years while the earnings played catch-up with the stock price. Then in 2000, Home Depot's P/E ratio expanded from 25x in 1997 to 75x. The stock topped shortly afterward. What does all this mean? As we've seen, what constitutes a high or low P/E is far less clear or important than you might have thought. What should you take away from this discussion? Should you ignore stocks that trade at relatively low P/Es and buy only those with high ratios? Not necessarily. The bigger point is that the P/E ratio doesn't have much predictive value for finding elite superperformance stocks. There is no magic number when it comes to the P/E. In fact, the P/E is far less important than a company's potential for earnings growth. Stop worrying about the P/E ratio. If you have a company delivering the goods as Apollo Group did, earning 40% per annum for 4 or 5 consecutive years, whatever the initial P/E was is irrelevant. The P/E takes care of itself. Leave the over-intellectualizing and complex theories to the professors and academicians, and the valuation tactics to the Wall Street analysts. An oceanographer may be able to explain all the complexities of waves, tides, water currents, and undertows. When it comes to riding a wave, however, I'll put my money on a 13-year-old kid from Malibu, California, who knows none of those facts but has surfed all his life and has an intuitive feel for the water. As a super-performance trader, you learn to spot and ride trends to big profits, and learn to detect when once advantageous trends appear to be breaking down. Often, once the why becomes known, profits taken or losses incurred will already be a matter of history. Valuing a company on intrinsic value is not trading stocks, it's buying assets. Your goal is to make money consistently, not accumulate a lockbox of assets that you really don't own, just pieces of paper that were made for trade. Chapter 5. Trading with the Trend. I don't set trends, I just find out what they are and exploit them. Dick Clark. My success as a stock trader relies on a combination of science and art. Mechanical signals backed by scientific research and intuitive feel are both important tools. In the stock market, few things are purely black or white. To succeed, an astute stock trader must learn to read between the lines and decipher, and make decisions often on the basis of incomplete information. There are, however, certain characteristics that are not ambiguous or even open for interpretation. I call them non-negotiable criteria. When I am screening for superperformance stocks, my initial filter is rooted in strict qualifying criteria that are based purely on a stock's technical action, and is designed to align my purchase with the prevailing primary trend. Once this initial criterion is met, I run overlay screens and look at the company's fundamentals to narrow the remaining universe of candidates. Simply put, no matter how good a company looks fundamentally, certain technical standards must be met for it to qualify as a buy candidate. For example, I will never go long a stock that is trading below its declining 200-day moving average, assuming 200 days of trading exist. No matter how attractive the earnings per share, revenue growth, cash flow, or return on equity may be, I won't consider buying a stock that is in a long-term downtrend. Why? I want to see some interest in the stock, preferably from big institutional investors. I'm not interested in being the first one to the party, but I do want to make sure there's a party going on. The goal is to eliminate stocks that are not worth my time so that I can focus on contenders that have the best chance of being the next super performers. Buying stocks in long-term downtrends will significantly lower your odds of owning a big winner. However, if you want to increase the odds, you should focus on stocks that are in a confirmed uptrend, making friends with the trend. Newton's first law states that an object in motion continues in motion. Things in motion possess inertia. An analogous property characterizes the stock market. A trend in force tends to remain in force until something occurs to change it. In other words, the trend is your friend. Although this adage is familiar, some investors may not fully appreciate its wisdom. I remember when I first grasped this concept in a meaningful way. In 1990, I attended an investment conference in New York City. On the roster of market gurus and prognosticators were Ned Davis, founder of the well-known institutional research firm Ned Davis Research, and Marty Zweig, publisher of the popular market newsletter, The Zweig Forecast. Marty coined the phrase, "The trend is your friend." One of the speakers who caught my attention not only for his colorful personality, but also for his approach to the stock market was Stan Weinstein, who at the time published the stock market newsletter, The Professional Tape Reader. Over lunch, We had a chance to chat, and as Stan explained his method, he left me with a core concept that has stayed with me ever since. Stan's approach was based on a timeless principle of the 4 stages that stocks go through, placing importance on knowing what stage a stock is in at any specific time. The ideal scenario, as Stan saw it, was to buy stocks when they are coming out of the first stage and beginning to make a run higher, which is the second stage. Then the objective is to sell them as they approach the peak of the cycle, which is the beginning of the third stage. The fourth stage, as you might guess, is a full-fledged decline that you want to avoid or during which you go short. I had previously read about Stan's approach in his book Secrets for Profiting in Bull and Bear Markets, McGraw-Hill, 1988. Although Stan wasn't the only one to use this type of 4-stage approach, he was the first I heard speak about it. I went on to adopt this concept as part of my stock analysis, superperformance and stage analysis. Like all stocks, superperformance stocks go through stages. Over the course of my trading career, I've taken a keen interest in studying the cyclical and secular life cycles of stock prices. In particular, in examining the historical price performance of the most powerful market leaders over many market cycles, I could clearly see how they go through various stages. A stock would trade sideways for a while and then move up rapidly. Eventually, the rate of upward momentum would slow and become more erratic as the stock was under distribution and topping out. After a top came the decline. Sometimes, after the decline, the stock returned to a basing stage before eventually making another run upward. The succession of one stage to the next, through all 4, could take several years. What I found through my study of the biggest price performers was that virtually every superperformance stock made its big gain while in stage 2 of its price cycle. As interesting as it was to study the stages of stocks' price maturation in hindsight, that didn't help me determine in real time when stocks on my radar were in the optimal stage 2 phase. Moreover, I asked, what created the profitable stage 2 advance? Hunting for a key to identifying the advent of second stages, I plotted and overlaid the underlying fundamentals of superperformance stocks to see how they correlated with price movement. My objective was to see whether there was any cause and effect in the movement from stage to stage, and if so, what it was. Stock price maturation, the 4 stages. My studies of big market winners gave me an in-depth view of each of the 4 stages of a stock's life cycle, from dormancy into growth to peak, and then into decline. In addition to focusing on stock prices, I asked what was happening to trigger each of these phases. From a fundamental perspective, the cause almost always was linked to earnings, from lackluster performance to upside surprise and accelerating growth, eventually followed by decelerating growth and then disappointment. These underlying fundamental changes drove big institutional players into and out of stocks, phases that could readily be identified by the huge volume spikes that occurred during both the advancing stage and the subsequent decline. I identify these 4 stages on the basis of what is happening with the stock in terms of price action. 1. Stage 1. Neglect phase consolidation. 2. Stage 2. Advancing phase accumulation. 3. Stage 3. Topping phase distribution. 4. Stage 4. Declining phase capitulation. Stage 1. The neglect phase consolidation. Stage 1 is when nothing noteworthy is happening. The stock is in a period of neglect. Few big players are paying attention to the stock, or at the very least, the market has not yet paid up for the company's shares. During Stage 1, a company's earnings, sales, and margins may be lackluster or erratic along with its share price. There may also be an uncertain outlook for the company or its industry. Nothing electrifying is happening to push the stock out of its doldrums and attract the needed institutional volume support to move it decisively into a Stage 2 uptrend. Stage 1 can last for an extended period, from months to years. Stage 1 can also be caused by a poor overall market environment. During a bear market decline, even stocks with good fundamentals can mark time and do nothing or even decline along with the overall market. You should avoid buying during Stage 1 no matter how tempting it may be. Even if the company's fundamentals look appealing, wait and buy only in stage 2. Remember Newton's first law, the law of inertia. An object in motion tends to stay in motion, and one at rest continues at rest. If your stock is dead in the water, guess where it's most likely to stay until something significant changes. You're not going to achieve super performance by sitting with dead merchandise. To compound capital at a rapid rate and achieve super performance, it is vital that you avoid stage 1 and learn to spot where momentum is strong during stage 2. Stage 1 characteristics. During stage 1, the stock price will move in a sideways fashion with a lack of any sustained price movement up or down. The stock price will oscillate around its 200-day or 40-week moving average. During that oscillation, it lacks any real trend, upward or downward. This dead-in-the-water phase can last for months or even years. Often, this basing stage takes place after the stock price has declined during stage 4 for several months or more. Volume will generally contract and be relatively light compared with the previous volume during the stage 4 decline. No bottom picking required. I can tell you from experience that attempting to bottom fish, trying to buy a stock at or near its bottom, will prove to be a frustrating and fruitless endeavor. Even if you are fortunate enough to pick the exact bottom, making significant headway usually requires sitting without much progress for months, and in some cases years, because when you buy a stock near its bottom, it is in stage 4 or stage 1, and therefore, by definition, lacks upside momentum. My goal is not to buy at the lowest or cheapest price, but at the right price, just as the stock is ready to move significantly higher. Trying to pick a bottom is unnecessary and a waste of time. It misses the whole point. To achieve super performance, you need to maximize the effects of compounding. Thus, it's important to concentrate on stocks that move quickly after you buy them. You want to focus on stocks that are already moving in the direction of your trade. To accomplish this, you should wait for a stage 2 uptrend to develop before you invest. Transition from stage 1 to stage 2. A stage 2 advance may begin with little or no warning. There are no major announcements or news. One thing is certain, however, a proper stage 2 will show significant volume as the stock is in strong demand on big up days and up weeks, and volume will be relatively light during pullbacks. There should always be a previous rally with an escalation in price of at least 25 to 30% off the 52-week low before you conclude that a stage 2 advance is underway and consider buying. In the following figure, note that the 200-day moving average for Amgen has turned up and is in a definite uptrend. The 150-day moving average is above the 200-day moving average, and the stock is trading above both the 150-day and 200-day moving average during the markup phase. Note, too, the surging volume on the rallies, contrasted with lighter volume on pullbacks. For Amgen, by the time stage 2 was clearly underway, the stock price had already advanced more than 80% from its 52-week low. This would be the point at which I would start to consider a new purchase. Any earlier lacks confirmation and is premature, meaning you run the risk of being stuck in dead money. Most amateurs would think the stock is too high and wish they had bought it when it was lower, using hindsight as a guide. That's why most amateurs don't make big money in stocks. Transition criteria. 1. The stock price is above both the 150-day and the 200-day moving average. 2. The 150-day moving average is above the 200-day. 3. The 200-day moving average has turned up. 4. A series of higher highs and higher lows has occurred. 5. Large up weeks on volume spikes are contrasted by low volume pullbacks. 6. There are more up weeks on volume than down weeks on volume. Stage 2, the advancing phase, accumulation. Although it may come without warning, a stage 2 advance can also be ignited by surprise news such as a beneficial regulatory change, a promising business outlook, or a new CEO whose vision could improve the company's prospects. Or perhaps it's a new company that suddenly attracts notice with a big earnings surprise that beat estimates. As the proverbial wind shifts and is now clearly at your back, the stage 2 advance signals the potential for clear sailing ahead. With a build-up in earnings momentum, or in some instances earnings expectations. The stock price starts to escalate because of a surge in demand for shares as big institutions buy the stock in size. A daily and weekly price and volume chart will show big-up bars representing abnormally large volume on rallies, contrasted with lower volume on price pullbacks. These signs of accumulation should appear during every Stage 2 advance. By the time Stage 2 is underway, the stock has been moving upward in a stair-step pattern of higher highs and higher lows. The share price may have doubled or even tripled at this point. However, this may be only the beginning. The stock could still move substantially higher. If the company continues to deliver strong earnings, the growth rate will soon attract widespread attention and subsequent buying, especially if the company has reported several quarters of impressive earnings gains. Stage 2 characteristics. The stock price is above its 200-day, 40-week moving average. The 200-day moving average itself is in an uptrend. The 150-day, 30-week moving average is above the 200-day, 40-week moving average. The stock price is in a clear uptrend, defined by higher highs and higher lows in a staircase pattern. Short-term moving averages are above long-term moving averages, e.g., the 50-day moving average is above the 150-day moving average. Volume spikes on big-up days and big-up weeks are contrasted by volume contractions during normal price pullbacks. There are more up days and up, weeks on above average volume than down days and down, weeks on above average volume. Stage 3. The topping phase distribution. As the saying goes, all good things eventually come to an end. In the market, stocks cannot keep up the momentum indefinitely, churning out ever-increasing percentages of earnings growth. At some point, earnings, though still increasing, are going to rise by a smaller percentage. The stock price may still be edging its way higher, although it may be experiencing more high-volume pullbacks and increasing volatility. During Stage 3, the stock is no longer under extreme accumulation. Instead, it is changing hands from strong buyers to weaker ones. Smart money that bought early when the stock emerged onto the scene is now taking profits, selling into final signs of price strength. As that occurs, buyers on the other side of the transaction are weaker players who know about the stock because it has made such a dramatic run and captured headlines. In other words, the long trade in the stock has become crowded and too obvious. This distribution phase exhibits a topping pattern. Volatility increases markedly, and the stock becomes visibly more erratic relative to its previous Stage 2 trading pattern. Earnings estimates that have been continually ratcheted up on continued upside surprises will be too high to beat at some point. A company cannot keep beating estimates forever. At some point, earnings per share, EPS momentum will start to slow. Either the stock price will anticipate that change, trading lower than it did before the actual earnings event, or there will be several quarters of slowing earnings growth deceleration, and then a breakdown in the stock price. Stage 3 characteristics. Volatility increases, with the stock moving back and forth in wider, looser swings. Although the overall price pattern may look similar to Stage 2, with the stock moving higher, the price movement is much more erratic. There is usually a major price break in the stock on an increase in volume. Often, it's the largest one-day decline since the beginning of the Stage 2 advance. On a weekly chart, the stock may put in the largest weekly decline since the beginning of the move. These price breaks almost always occur on overwhelming volume. The stock price may undercut its 200-day moving average. Price volatility around the 200-day, 40-week moving average line is common as many stocks in Stage 3 bounce below and above the 200-day average several times while topping out. The 200-day moving average will lose upside momentum, flatten out, and then roll over into a downtrend. Stage 4, the declining phase, capitulation. As the company starts to lose its EPS momentum and earnings slow down, at some point there will be a negative surprise. The company will miss an earnings estimate or pre-announce earnings and guide Wall Street analysts lower. For some stocks in certain industries, this may be foretold by inventories, with a buildup of finished product or retail goods that reflects declining demand or greater competition in the marketplace, which hurts the company's growth prospects. What was once an uptrend that then transitioned into a topping phase has turned into a full-blown Stage 4 downtrend. During Stage 4, earnings models are generally revised downward, which puts more selling pressure on the stock. The Stage 4 selling may continue for an extended period until it's finally exhausted, and the stock enters another period of neglect. As a stock languishes, it's back to Stage 1. It may take a while for the company to get back on the growth track and return to strong earnings, or the company may remain in Stage 1 for many years. In some cases, the company may go bankrupt. Stage 4 is essentially the opposite of Stage 2 in terms of price and volume characteristics, with higher volume on down days and lower volume on up days. You should definitely avoid buying while a stock is in Stage 4. Stage 4 characteristics. The vast majority of the price action is below the 200-day, 40-week moving average. The 200-day moving average, which was flat or turning downward in Stage 3, is now in a definite downtrend. The stock price is near or hitting 52-week new lows. The stock price pattern is characterized as a series of lower lows and lower highs, stair-stepping downward. Short-term moving averages are below long-term moving averages. Volume spikes on big down days and big down weeks are contrasted by low volume rallies. There are more down days and weeks on above average volume than up days and up weeks on above average volume the price maturation cycle. Now that we have broken down the 4 stages individually, it's important to understand that the study of the 4 stages of a stock's life cycle is not meant for pinpoint timing purposes, which requires a more precise approach and tactics that I will discuss below. Rather, the 4 stages are most useful for gaining perspective on where a stock is in its life cycle price-wise, and then to compare that with where the company is in its earnings cycle. A stock can go through the cycle many times. By studying the 4 stages, you will see clearly that you want to be involved in Stage 2. I'm not at all interested in getting in early when a stock is still in Stage 1. And I definitely don't want to hang around for Stage 3, let alone Stage 4. Using Amgen as an example of a stock cycling through the various stages, you can clearly see why you would want to be long during Stage 2 and avoid the other stages. F5 networks transitioned quickly from Stage 3 to Stage 4 and declined more than 50% in only 8 months. Weight Watchers topped in May 2011, but took a year to build a Stage 3 top before transitioning to Stage 4. Novell topped in 1993. With the exception of a bear trap rally in 1995, the stock price spent the next 5 years in a Stage 4 decline, falling more than 80%. Novell was unable to transition into Stage 2 and set up constructively. How to pinpoint Stage 2? As I've stated, history clearly shows that virtually every super-performance stock was in a definite uptrend before experiencing its big advances. In fact, 99% of super-performance stocks traded above their 200-day moving averages before their huge advance, and 96% traded above their 50-day moving averages. I apply the trend template criteria, see below, to every single stock I'm considering. The trend template is a qualifier. If a stock doesn't meet the trend template criteria, I don't consider it. Even if the fundamentals are compelling, the stock must be in a long-term uptrend, as defined by the trend template, for me to consider it as a candidate. Without identifying a stock's trend, investors are at risk of going long when a stock is in a dangerous downtrend, going short during an explosive uptrend, or tying up capital in a stock lost in a sideways neglect phase. It's important to point out that a stock must meet all 8 of the trend template criteria to be considered in a confirmed Stage 2 uptrend. Riding the tide, timing the waves. By using the trend template criteria, you will be able to immediately identify companies that are in a Stage 2 uptrend. There will be no guesswork involved. However, we are not buying a stock just because it happens to be in a Stage 2 uptrend. Therefore, it's important to consider what happens within the Stage 2 acceleration. To illustrate, Think of the upward movement during stage 2 as high tide coming in. As you know, the tide doesn't come in all at once. It arrives on successive waves that take the water level steadily higher. The overall direction of the trend is upward, but within it, there are pulses or waves of movement. Within an overall long-term uptrend, the tide there will be short or intermediate-term price action, the waves that consist of pullbacks and basing. These shorter-term moves may last from 4 or 5 weeks up to a year or more in many cases. Most commonly, base patterns forming within a stage 2 uptrend last anywhere from 5 to 26 weeks. During these basing periods, the stock will basically go sideways for a while, as if it's catching its breath before making the next push higher. This sideways price is not to be confused with a stage 1 phase. The stock is now in a stage 2 uptrend, stair-stepping higher from base to base. This will continue all along the stage 2 advance. Where are we on this mountain? The base count, switching metaphors, think of the movement of a stock's price through the 4 stages of its life cycle as the outline of a mountain, from the flatlands to the summit and back to the flatlands again. As the mountain rises up the left side, stage 2, there are areas where the path or ascent plateaus for a bit. This is where mountain climbers would build a base camp, rest, and recharge, getting ready for the next phase of the climb to the summit. That's exactly what happens with a stock. After a run upward, there is profit-taking, causing a temporary pullback, during which the stock builds a base. If the stock is truly in the middle of something significant, the longer-term trend will resume. The short-term pauses allow the stock to digest its previous run up so that it can move even higher as it emerges from a constructive consolidation period. At some point, the upward momentum ceases, the stock tires, and the top is put in. This is like reaching the summit, and there is no more mountain left to climb. Now comes the descent. Generally, this occurs after 3 to 5 bases have formed along the way in a stage 2 uptrend. The later stage bases coincide with the point at which the stock's accumulation phase has become too obvious, tapping out the last of the heavy institutional demand. Bases 1 and 2 generally come off a market correction, which is the best time for jumping on board a new trend. As the stock makes a series of bases along the stage 2 uptrend, base 3 is a little more obvious but usually still tradable. By the time a 4th or 5th base occurs, if it gets that far, the trend is becoming extremely obvious and is definitely in its late stages. By this point, abrupt base failures occur more frequently. Some stocks, however, can turn up in a parabolic fashion and end in a climax run or blow off top. By itself, base counting will not tell you if a stock has topped or is about to move substantially higher. It does, however, provide a great way to gain perspective on where you are within the stage 2 advance. Combined with specific price and volume analysis, along with fundamental analysis, it can be a very powerful tool. Base counting was introduced to me by Bill O'Neill and David Ryan many years ago. It is a valuable way to ascertain where a stock is within its price maturation cycle. Trust, but verify. I never place much faith in my fundamental ideas about a particular company without confirmation from the market, namely, the price of the stock. The way I see it is simple. If a company's management is so great and its products are so great, the stock should at some point reflect those fundamentals. If strong fundamentals are not confirmed by the stock's price action, the future may not be as bright as it appears. Or perhaps investor perception of the company has not changed or has not materialized yet. You want to get on board when institutional money is pouring into a stock and lifting it significantly higher. To do that, you need confirmation that this inflow is starting to happen before you invest. Why is price action so important? Even if you're correct in your fundamental analysis of the company, investor perception is what creates buy orders, and you are going to need big buy orders in your stock to move it up significantly. Keep in mind that if the institutional investment community doesn't see what you see, your stock could sit dormant for an extended period. Why sit and wait when you can put your money in another stock that is already on the move higher and has attracted big institutional volume support? To compound your capital rapidly, you must be where the action is. You can't afford to have your money tied up in a stock waiting for what you think is a great fundamental story to get noticed by the rest of the world. I'm willing to give the first leg up in a stock to someone else in exchange for confirmation that the trend is definitely in stage 2, with some momentum building. The goal is not to buy at the cheapest price, but to sell your stock for significantly more than the price you paid in the shortest period. That's how superperformance is achieved. Heed a trend reversal. At some point your stock will reach its highest price and top out. This can occur with or without warning. Regardless of your fondness for or attachment to a particular security, it's important that you learn to detect and, more important, respect a change in trend. Stocks very often top out while earnings still look good. Investors who wait for the earnings picture to dim before hitting the bid in the face of a stage 3 top or stage 4 decline often end up with a huge loss, or at the very least give back much if not all of what they made on the upside. When topping signs start to appear after a long, extended price run, it's time to take your profit and head for the exit. Companies will announce record earnings and try to create hype to keep their stocks up. Carefully watch the stock's price action for valuable clues to which way institutional investors are leaning and, like a tree, bend with them. If you are inflexible and fight the powerful force of institutional money flow, you risk being snapped like a brittle twig. Financial stocks warn of impending trouble. The news media would have you believe that the troubles in financials in 2008 came out of nowhere. The truth, however, is that the stock prices of financial companies were falling in a stage 4 decline for many months, warning of trouble ahead. All you had to do to avert a major disaster was heed the stage 4 decline and sell. Even if you bought near the all-time high price, you could have taken a relatively small loss on many of the bank stocks that ended up being a total disaster, that is, if you had paid attention to the danger signs. For many of the financial stocks, such as Citigroup and Bank of America, there were clear-cut warnings. At the time, if you held those names, you should have sold or at least reduced your position progressively until you were in cash. Trust your eyes, not your ears. When a stock shows signs of topping or, even worse, enters a stage 4 decline, you should trust what you see, not what you hear. Tune out the analyst and discount company hype. The chart of Vickers shows that by the time the flat earnings were reported, which was a dramatic deceleration from the previous trend of triple-digit growth, the stock had already suffered a vicious decline. This was the result of large institutional investors anticipating a loss of earnings momentum going forward and exiting the stock in anticipation. By the time a material change in earnings was reported, Vickers' stock price had already declined by almost 70%. As you look at Crocs next, note how the negative quarter minus 71% was reported long after the stock topped, and not until the price was already down 73% from its high. This demonstrates clearly why you cannot wait for a fundamental change when the price action of a stock turns volatile or hostile into stage 3 or, even worse, stage 4. To be successful, you must respect the trend and the wisdom of the market. Croc's weekly chart shows the mass exit taking place as big institutions unwind positions as the stock quickly transitions from stage 2 to stage 4. Brokerage house opinions. Should you buy a stock on the basis of a brokerage house's recommendation? If the stock is in a stage 4 downtrend, definitely not. Big brokerage houses love to recommend stocks that are down in price. Often these upgrades are based on valuation and completely ignore the fact that the stock price suffered a major price break. Often, stocks that are upgraded on the basis of valuation after a large price decline turn out to be good short candidates. Learn to do your own analysis and base your purchases on sound criteria, not because someone else says a broken stock is a good value. We put CMG on our short alert list 8 days before Citigroup raised its rating to buy. 3 months later, the stock was down 40%. A material change in behavior is a major warning. Institutional investors can become wary of what had been a strong performer. They can suddenly send a stock plummeting as they get out. When that happens, take heed. Before it becomes apparent that the fundamentals have changed, A major break in the stock price often will occur on overwhelming volume. If your stock experiences its largest daily and or weekly price decline since the beginning of the Stage 2 advance, this is a sell signal in most cases, even if it comes on the heels of a seemingly great earnings report. Don't listen to the company or the media. Listen to the stock. I have seen companies report earnings that were only a few cents better than expected on in-line revenues and skyrocket. And I have also seen companies report earnings and sales much better than expected, but the stock sold off hard and could not recover. After the market close on October 31, 2007, Crocs reported quarterly earnings per share of $0.66 versus a consensus of $0.63. Although this report was 144% ahead of the previous year and even beat street estimates, the stock's reaction was less than enthusiastic, falling 36% in just one day on overwhelming volume after the earnings release. Notwithstanding a one-day 5% dead cat bounce, short-term recovery from a sell-off that did not resume the uptrend, the share price dropped another 29% over the next 6 trading days. On November 13, 2008, Crocs stock traded as a penny stock at $0.79 per share, down 99% off a high of $75 just a year earlier. Many times before a fundamental problem is evident, there will be a hint in the form of a material change in price behavior. That change should always be respected, even if you don't see any reason for the sudden change in sentiment. Earnings may still look good. The story may still be intact. However, in most cases, you'll be far better off getting out, shooting first and asking questions later, than waiting to learn the reason why. When a stock that had been in a strong Stage 2 suddenly goes into a Stage 3 topping pattern or transitions quickly into Stage 4, don't sit there and assume that everything is fine. There is a reason for the adverse price move. You just don't know it yet. Whatever you do, don't think that a big break in the stock is now a buying opportunity. Many investors get caught in this trap. A stock they own suddenly declines sharply. Believing that the marketplace must be wrong and that the stock is still a good performer, they decide it's time to buy more. They don't realize that the stock price is down because the big players know, or at least suspect, something is wrong and are getting out. When you see that happen in the price action, regardless of what the fundamentals are saying, it's time to exit. Let the wind fill your sails. As we've discussed in this chapter, to achieve super performance, you need the powerful force of institutional buyers on your side to propel your stock's price sharply higher. A proper Stage 2 uptrend provides evidence that institutions are indeed stepping up to the plate, just as a Stage 4 decline clearly demonstrates the opposite. Having the long-term trend on your side is like sailing with the wind at your back. If there's no wind, you're dead in the water Stage 1. And if the wind is against you, you have little chance of moving forward Stage 4. The proverbial wind in your sails is the long-term trend of big money that's buying in sync with you. You should look to align yourself with this powerful force. Stick with stocks that are in a solid uptrend, and you will be much more likely to own a stock that has the potential to skyrocket and become a super performer. Chapter 6. Categories, Industry Groups, and Catalysts. When I'm considering a stock for purchase, the first thing I do is determine the type of situation I'm dealing with. In the context of the nature of the business and the industry in which a company operates, I want to develop an expectation of its prospective earnings growth and find out whether those prospects are widely recognized and therefore discounted in the current stock price. Categorizing companies is a good way to gain perspective and organize your thoughts about a particular stock. It will help you establish the type of company you're considering relative to others in the market so that you can make a judgment about where the stock is in its maturation cycle or curve. Companies don't stay in the same part of the curve forever, and some spend more time than others in certain phases of the cycle. However, nearly all companies undergo a natural maturation. Over the years, I have analyzed tens of thousands of publicly traded companies. What I've discovered is that they generally tend to fall into one of 6 categories. 1. Market leaders. 2. Top competitors. 3. Institutional favorites. 4. Turnaround situations. 5. Cyclical stocks. 6. Past leaders and laggards. The market leader. My favorite type of stock to invest in the area where I have made most of my money trading is the market leader. These companies are able to grow their earnings the fastest. An industry's strongest players are usually number 1, 2, or 3 in sales and earnings and are gaining market share. Market leaders are easy to spot, but most investors have psychological difficulty deciding to buy them. The share prices of market leaders power up the most percentage-wise in the initial stages of a market rally. They move into new high ground first. That unbelievable price strength causes most investors to think these stocks have run up too far. Hence, most investors are afraid to buy the very best stocks capable of super performance. What propels them even higher? Institutions that know enough about a company and its future prospects provide the buying power. They are not concerned about how far the stock has already advanced, but about where it's going and what the prospects are for future growth. The best type of growth situation is scalable growth, a company gaining market share in a rapidly growing industry. The market for the company's products or services is extremely large in relation to the company's size, and those products and services are in high enough demand that the company can grow at a high rate for an extended period. These companies have superior products and services, and they are often part of a growing industry. Although it is not necessary that a market leader be in a fast-growing industry or sector, it is certainly an additional plus if it is. A company that is taking market share in a slow-growth industry can also grow its earnings quite nicely. What's most important is that the company can make substantial profits. A good balance sheet, expanding margins, high return on equity, and reasonable debt are all signs of good management. Some market leaders grow earnings at a very healthy rate for extended periods in industries, with percentage growth rates in the low to mid-single digits. However, a company that is taking market share or has a large portion of market share in a fast-growing industry can increase its earnings at a meteoric pace. The main questions should be, what is the company's competitive advantage? And is the business model scalable? Then it's a matter of whether management is executing successfully and delivering the goods, namely, earnings. Market leaders are capable of producing huge price appreciation during their high growth phase. They generally grow earnings at a rate of 20% or higher. Many average 35 to 45% during their best 5 or 10-year stretch. During their greatest growth period, some increase their earnings at triple-digit rates. From March 1989 through May 1993, Cisco Systems averaged over 100% quarterly earnings growth. Cisco's stock price advanced more than 13-fold in that period. During the early 1980s, when Walmart was a little-known company trading as few as 20,000 shares a day, earnings growth averaged 38% for 14 consecutive quarters. Walmart's stock price appreciated 1,000% in that period. Today, Walmart trades more than 7 million shares a day on average, when expensive is actually cheap. Market leaders in the high-growth stage are almost always going to appear expensive. It only makes sense to value a rapidly growing company higher than a slower-growing one. Here's the beauty about ultra-fast growers. These companies grow so fast that Wall Street can't value them very accurately. This can leave a stock inefficiently priced, providing a big opportunity. As long as a company can sustain significantly expanding sales and earnings, the stock price will follow. Maybe not immediately, but stock prices do follow earnings growth over time. The faster a company can grow earnings, the more likely it is that its stock price will follow. Don't be misled. There's plenty of risk in high-growth companies. Wall Street can punish a fast-growing company if earnings slow down even by the smallest amount in relation to expectations. High-growth companies live and die by earnings expectations. These companies have to constantly beat consensus forecasts. As a company reports better than expected earnings, the bar moves up for that company to beat them the next time. Eventually, the bar is too high and the company misses. However, as long as the company can deliver strong earnings and manage expectations well, the stock price can soar and experience P and E multiple expansion. The goal is to identify and invest in market leaders relatively early in the growth phase when profits are accelerating. The category killer. Every so often a company comes along and totally dominates a category. The company has such a clear and sustainable competitive advantage that other firms in the same market or niche find it nearly impossible to compete. These market leaders are known as category killers. A category killer is a company whose brand and market position are so strong that it would be difficult to compete against it, even if you had unlimited capital. A good example is eBay, with an online auction site that gives it an overwhelming advantage since buyers and sellers want to participate in the biggest market with the most players. Therefore, they come to eBay, which gobbles up the opportunity, leaving everybody else with the crumbs. Consider Apple, which dominates its space, setting the prevailing trend with innovative technologies and truly unique products. Disney's theme parks certainly rank as a category killer with little formidable competition. So does a company such as Walmart, which has taken a toll on the retail sector, in which many stores find it hard to compete against the giant. The cookie-cutter concept. When a firm produces a successful formula in one store and then replicates it over and over in malls and in locations around the country or around the world, it's a cookie-cutter. Think of McDonald's, Walmart, Starbucks, Taco Bell, The Gap, Home Depot, Starbucks, Chili's, Cracker Barrel, The Limited, Dick's Sporting Goods, Wendy's, Outback Steakhouse, and Costco Wholesale, which are great examples of successful rollouts of the cookie-cutter concept. As you can see, many of the names that achieve success with the cookie-cutter business model are in the retail area. With this concept, when a company expands into new markets, bringing on new stores rapidly, especially if same-store sales are brisk as well, earnings can accelerate at a healthy, sustained pace. These types of companies are some of the easiest to spot, monitor, and invest in during their high growth phase. Their earnings up cycles last for a long enough time for you to identify earnings growth on the table, while they still have plenty of growth in the future. Points to consider when investing in the cookie-cutter model. Same-store sales, or what is also referred to as comparable store sales comps, are a very important statistic used for analysis of the retail industry. This statistic compares sales of stores that have been open for a year or more. This allows investors to determine which portion of new sales has come from sales growth and which portion from the opening of new stores. This analysis is important because, although new stores are a major part of a company's expansion and earnings growth, a saturation point in which future sales growth is determined by same-store sales growth eventually occurs. With these comparisons, analysts can measure sales performance against other retailers that may not be as aggressive in opening new locations during the evaluated period. You want to see same-store sales increasing each quarter. High single-digit to moderate double-digit same-store sales growth is high enough to be considered robust, but not so high that it's unsustainable. 25 to 30% or more same-store sales growth is definitely unsustainable over the long term. In general, same-store sales growth of 10% or more is considered healthy. What factors affect same-store sales? The two main factors are prices and customer volume. By measuring the sales increase or decrease in stores that have been open a year or more, you can get a better feel for how a company is really performing, because this measure, same-store sales, takes store closings and chain expansions out of the mix. Rising same-store sales means that more customers are buying product at the stores or are spending more than they did a year ago or some combination of the two. This is a sign that management's marketing efforts are paying off and that the brand is popular with consumers. Falling same-store sales obviously represents a problem. Weakening comps could mean one of a few things. The brand is losing strength, and people aren't shopping at the company's stores. The economy is worsening, and people aren't interested in shopping anywhere. The company has too many items at discount prices, and dollar volume per customer is less than usual. Some companies grow by franchising their business or through a combination of company-owned and franchised stores. Although franchise fees can lead to big profits for the franchisor, The earnings are considered lesser quality than a company-owned base with less earnings stability. If the company franchises a relatively high percentage of new store openings, the risk of store failures and an earnings disappointment is heightened. In 2007, McDonald's, one of the best-run franchise cookie-cutter models in history, had about 60% of its restaurants operated by franchisees. Another important consideration for the cookie-cutter model, particularly if the business concept is relatively new, is a past track record of success in diverse geographic locations, Northeast, South, Midwest, international, etc. You want to get evidence that the model is scalable. In addition, too much, too fast can be a red flag. For most companies, opening more than 100 stores per year is a number that is difficult to maintain. In 2006, Starbucks opened 1,102 more stores than it had the previous year. Starbucks stock price peaked and fell 82% over the next 24 months. By 2011, Starbucks had fewer stores open than it did in 2008. Other key metrics to consider include comparing sales per square foot and sales per dollar of capital invested per unit with other companies in the same business. The top competitor. Keep your eye on the competition. Usually only 1, 2, or possibly 3 companies truly lead an industry group. If I asked you to name the number 1 and number 2 soft drink companies, you would almost surely say Coca-Cola and Pepsi. If I asked you who was number 3, could you give as quick an answer? How about coffee, Starbucks and Dunkin' Donuts perhaps? Or home improvement, Home Depot and Lowe's? Keep in mind that we're looking for the next super performers, the Starbucks, the Apple, the Google of tomorrow. In 1981, MCI Communications challenged the dominant market leader AT&T. MCI reported strong earnings as the stock price emerged from a 17-week consolidation and made a new high on April 2, 1981, but that was only the beginning. Over the ensuing 22 months, MCI's stock advanced 500%. A top competitor may not be the superior company in an industry group, or even have superior products compared with the true market leader. Rather, it's in the right place at the right time. Even though it may be in the same rapidly growing industry as the market leader, the company's products or stores may be less popular or in some way inferior to those of the leader. These competitor companies can also produce high rates of earnings growth and enjoy large-scale price advances, albeit inferior to that of the leader. Even so, the number 2 company in an industry can eventually take market share from the leader and in some cases take over the number 1 spot. The stock prices of top competitors can reflect this phenomenon, performing relatively well while the market leader digests its previous stock gains. From 1990 through 2000, Home Depot's stock price advanced 3,700%, more than a 40% compounded annual rate of return. During that period, Lowe's stock advanced only 1,000%, amassing only about a quarter of Home Depot's price advance. Then, from January 2000 through January 2004, Lowe's stock price ran up more than 100% while Home Depot's stock price actually fell, giving back more than 40% from its all-time high. This put the 14-year track record for Lowe's up 2,900% and for Home Depot up only 1,800%. Home Depot had been the leader for more than a decade, and for investors who saw its potential, it was just a matter of when they got on board. Always track the top 2 or 3 stocks in an industry group. The online access provider America Online was the clear leader in the internet market until the search engine Yahoo moved into the top slot. Google, a direct competitor to Yahoo, then went public and is now considered the number 1 powerhouse in search engines. A competitor of the market leader can offer a great investment opportunity, especially if it's in a strong industry group. Like a NASCAR racer who follows in the leader's draft, waiting to make a pass at the right moment, a top competitor can ride the heels of a market leader and eventually win market share. You should concentrate on the top 2 or 3 stocks in a group, the leaders in terms of earnings, sales, margins, and relative price strength. This is especially true if the industry group is a leading sector during a bull market. Netflix goes public, Blockbuster tops. It's no coincidence that within only 15 trading days of Netflix going public, Blockbuster Video's stock permanently topped out. It makes sense. Competition rears its head, providing a more convenient solution to the movie rental business. Blockbuster's stock price topped at the same time Netflix came on the scene, almost as if the dollars from its shares were rotating directly out and into its new competitor. I could see this story unfolding in my own neighborhood as the mom and pop video rental stores went out of business one by one. Then the small regional chains started closing their doors, and the writing on the wall was beginning to look crystal clear. Brick-and-mortar video rental was on its way out. Coming off the market bottom in 2009, Blockbuster was plagued with declining sales as the stock traded as low as $0.13. This was off a high of $18.00. Meanwhile, on March 18, 2009, just 7 days after the Nasdaq Composite traded at its bear market low, and only 10 days after the Dow traded at its bear market low of 64.69, Netflix hit an all-time high. Just 17 trading days later, Netflix's stock price was up an additional 20%. Sales had been brisk and accelerating over the previous 3 quarters from 11% to 16% and 19%, respectively. Earnings were even more impressive, up 36%, 38% and 58%, respectively. In October 2009, I was buying Netflix shares. Netflix's earnings, sales, margins, return on equity, and debt levels all were superior to those metrics at Blockbuster. Netflix was trading at 32x earnings while Blockbuster traded at just 2x earnings, which stock was really the cheap stock. From the point at which Netflix went public, the stock increased more than 3,400%. During the same period, Blockbuster's stock price lost 99% of its value. The institutional favorite. Institutional favorites are also referred to as quality companies or official growth stocks, but don't let those titles impress you too much. These are mature companies, and they're certainly no secret. They generally have a good track record of consistent sales and dividend growth, and they often attract conservative institutional capital because of their proven history of management's ability to increase earnings, expand margins, and create shareholder value. Their earnings growth is generally in the low to middle teens. These companies are regarded as the ones that most likely won't go out of business. Often they are referred to as blue chips or stalwarts. Examples include Coca-Cola, Johnson & Johnson, and General Electric, to name a few. Although all that sounds good, there's one problem. They're usually big and sluggish by the time they reach institutional favorite status. Although their earnings are deemed to be consistent and of high quality, usually the growth is slow, and the companies are so widely followed that there's little room for rapid price appreciation. In certain markets, these stocks can come into favor and do quite well. However, you're not likely to get a super performance move out of General Electric or Procter & Gamble. Sometimes mismanagement, some other misfortune, or a severe bear market correction will drive some of these companies down precipitously. As the stocks recover, they can make a nice advance coming out of the correction phase. The turnaround situation. Big profits can be made in troubled companies that turn around. In purchasing a turnaround situation, you should look for companies that have very strong results in the most recent 2 or 3 quarters. You should see at least 2 quarters of strong earnings increases or 1 quarter that is up enough to move the trailing 12-month earnings per share to near or above its old peak. In looking at turnarounds, ask yourself, are profit margins recovering, and are they at or close to the peak? Are the results based only on cost cutting? What is the company doing to increase earnings beyond cost cutting, productivity enhancements, and shedding losing operations? How much cash does the company have? Although a company can burn its cash, you can try to assess the burn rate and debt load to get an idea of how long it can last while running in the red. How much debt does the company have? Bank debt is the worst kind and is less favorable than bond debt. How long can the company operate while it works out its problems? It's important to follow the story and ascertain whether the turnaround is running better than, worse than, or as expected. Worse than expected is usually a reason to consider selling. I look for acceleration in the growth rate in the most recent couple of quarters compared with the 3- and 5-year growth rate, which often is negative or reflects very slow growth. The most important questions to ask in purchasing a turnaround are: is the stock acting well in market? And are the fundamentals coming in strong? You want to see both. Turnaround stocks are up against relatively easy comparisons from earlier quarters, and so it's important to see the most recent results up significantly. Generally 100% growth or more in the most recent 2 or 3 quarters, and a dramatic acceleration versus the past growth rate. Remember, stocks don't necessarily stay in one category forever. This is why it's important to understand the dynamics that are taking place with regard to a company's products and services, and the potential for sales growth. Apple Computer was a turnaround situation that morphed into a growth stock, and since then has reached institutional favorite status. From 2001 to 2003, revenue and margins were under severe pressure, which in turn led to lackluster earnings and a falling stock. The price of Apple's shares was down more than 80% from its high. Things were so bleak that when Michael Dell, founder of rival computer maker Dell Inc., was asked what he would do if he ran Apple, he said he would shut it down and give the money back to the shareholders. However, a new product can bring new life to a dormant company, and the release of the iPod in 2001 and iTunes stores in 2003 was about to fuel what has been called the greatest turnaround in corporate history. From 2003 to 2011, Apple's net profit margins increased every year from just 1.2% to an impressive 23.9%. During that period, revenue growth averaged 39% per year. With the rapid expansion of margins and strong sales, earnings soared, averaging 114% per year. From its 2003 low, Apple's stock price increased in value by more than 10,000%. 73% of that phenomenal growth came from newly launched products. Cyclical stocks. Buying a cyclical after several years of record earnings, and when the P/E ratio has hit a low point, is a proven method for losing half your money in a short period of time. Peter Lynch. A cyclical company is one that is sensitive to the economy or to commodity prices. Examples include auto manufacturers, steel producers, paper stocks, and chemical companies. Interestingly, cyclical stocks have an inverse P/E cycle, meaning they generally have a high P/E ratio when they are poised to rally, and a low P/E near the end of their cycle. This is due to the fact that Wall Street analysts try to anticipate the earnings cycle dynamics of these companies, which are dependent on the business cycle. Growth investors may become confused when they attempt to apply an earnings model to the selection process for cyclical stocks, and their stock picks do not respond like a cookie-cutter retailer or a high-growth technology company poised for many continued quarters or even years of growth after earnings are already on the table. This is the reason I put them into their own category and apply a slightly different approach from what I do with stock categories that have sustainable growth prospects. With cyclical stocks, the trick is to figure out whether the next cycle turn is going to happen earlier or later than usual. Inventories and supply and demand are important variables in analyzing the dynamics of cyclical stocks. When the P/E ratios of cyclical stocks are very low after earnings have been on the rise for many months or several years, it's often a sign that they are near the end of their upcycle. When P/Es are super high and you've heard nothing but doom and gloom about the company or industry for an extended period, the bottom may be near. At the bottom of a cyclical swing, the following things happen. 1. Earnings are falling. 2. Dividends may be cut or omitted. 3. The P/E ratio is high. 4. News is generally bad. At the top of a cyclical swing, 1. Earnings are moving up. 2. Dividends are being raised. 3. The P/E ratio is low. 4. News is generally good. Stay away from the laggards. A laggard is a stock that belongs to the same group as the market leader but has inferior price performance, and in most cases inferior earnings and sales growth. These stocks can have periods of decent performance, usually brief ones, as they try to catch up with the true leaders near the end of a cycle, or during times when a sector is red hot and the real leader has run up rapidly. The price moves in laggard stocks, however, usually pale in comparison to those of the true market leader. Laggards usually appear to be relatively cheaper than market leaders, and that attracts unskilled investors. Don't be tempted by a stock with a relatively low P/E or one that hasn't appreciated as much as has the leader in its industry. There's always a reason why one stock trades at a high multiple and another trades at a low multiple. More times than not, the expensive market leader is actually cheap, and the laggard is really the more expensive choice. Over the years, many people thought buying Wild Oats, the smaller rival to Whole Foods, was a better way to play the healthy food trend because of its lower P/E. There was a good reason for the low P/E. Wild Oats failed to generate much in the way of earnings growth. Investors who concentrated on earnings growth made a lot more money by owning Whole Foods, even though it was popularly perceived to be more expensive than Wild Oats. Whole Foods rarely traded below 30 times earnings during its dramatic growth phase. On the surface, it's not surprising that many investors passed on a grocer with such a high P/E, but if they had understood the growth opportunity, the high P/E wouldn't have mattered much. The key for Whole Foods was its ability to expand earnings at a high rate, growing by more than 20% on average. By doing that, the stock paid off big for its investors. Specific industry groups lead new bull markets. The formation of a bear market bottom typically begins with signs of accumulation in certain market sectors or segments. In general, 3 or 4 to as many as 8 to 10 industry groups or subgroups lead a new bull market. The market can also have a broader theme such as growth, value, small cap, large cap, and so on. The leadership groups or categories can start to stage their bull market rallies before the broad benchmark's bottom. For example, at the 1974 market bottom, mid-cap and small-cap stocks began to show noticeable signs of accumulation during September and October, even though the major market indexes did not bottom until December. When a new bull market began in March 2003, it was already apparent that investors had been accumulating financial, energy, and basic material stocks, as well as mid-caps and small caps, for several months. How do you find which groups are leading? Follow the individual stocks. I like to track the 52-week new high list. The industry groups with a healthy number of stocks hitting new highs early in a bull market will often be the leaders. Your portfolio should consist of the best companies in the top 4 or 5 sectors. In a bull market, some sectors advance several 100% and others barely beat the average or even underperform. There are broad sectors that include a wide range of companies and subgroups. Healthcare and medical, technology, services, basic materials, consumer cyclical, consumer non-cyclical, financial, transportation, capital goods, energy, and utilities are all broad sectors. In each sector, there are subsectors or industry groups. For example, in the healthcare and medical sector, subsectors include drugs, generic drugs, ethical drugs, biotechnology and genetics, HMO, hospitals, nursing homes, outpatient home care, medical equipment, medical services, and medical supplies. Buying into the leading areas early in a bull market can lead to significant capital gains. Some groups start emerging late in a bull cycle and can lead during the next upturn after a bear market. It's definitely worth investigating the industry groups in which the most stocks were resisting the decline, and then subsequently broke into new highs while the market was coming off its lows or during the market's initial few rallies. The top relative strength leaders in these groups typically lead their group's advance from the beginning and are likely to show the greatest appreciation. When you see a growing number of names in a particular industry making new 52-week highs, especially coming off a market low, this could be an indication that a group advance is underway. I tend to let individual stocks lead me into an industry group or sector, taking more of a bottom-up approach as opposed to top-down. I have found that more often than not, the best stocks in the leading groups advance before it's obvious that the group or sector is hot. Therefore, I focus on stocks and let them point me to the group. Not always, though. I still stay in touch with what is happening on an industry-wide level, and if I see something that attracts my interest, I look at the stocks that make up the industry and sort them according to my criteria. I look at the strongest stocks first, the ones that have the best earnings and sales, are closest to a new high, and show the greatest relative price strength versus the market. This is where you find the real market leaders. History shows that big winning stocks tend to favor certain industry groups. The groups that have produced the largest number of super performance stocks include the following: consumer and retail, technology, computer software and related, drugs, medical and biotech, leisure and entertainment. New innovations create new opportunities. Material changes in underlying conditions can have a dramatic effect on group performance. This doesn't mean that a stock must belong to a strong group to make a big advance or imply that a strong tide will lift all the proverbial boats higher. Be on the lookout for new industries and companies with market niches, specialized expertise, proprietary technology, or a positive sector change such as deregulation. Look for new technologies or adaptations of old technologies that promise to help people work better, live longer, and enjoy life more, or that help companies cut costs and improve productivity and efficiencies. Look for opportunities in companies undergoing positive changes. You can read industry trade magazines. You can call company representatives and ask which publications they recommend for keeping up with new industry events and happenings in their field. When a new category is established or a company creates a new industry, often it's an extension of a broader group category. For example, U.S. Surgical was a medical products company. After it pioneered the surgical staple in 1987, a whole new medical approach became its own niche. In the early 1990s, U.S. Surgical introduced the EndoClip, which allowed laparoscopic gallbladder removal, and the market for those devices began to grow rapidly. Soon, laparoscopy was also being used for hernia operations, appendectomies, hysterectomies, and other types of abdominal surgery. With a virtual monopoly on sales of the equipment for these operations, U.S. Surgical saw its sales grow by 50% in 1990 and 75% in the first half of 1991. Earnings during that time grew by 78%, and by the end of the year they had nearly doubled. U.S. Surgical sold more than $300 million worth of laparoscopic equipment in 1991 to become one of the fastest-growing companies in the United States, with profits of $91 million. Just a few years earlier, U.S. Surgical had sold only $10 million worth of laparoscopic tools. By 1992, the company's revenues for the year surpassed $1 billion. Group cycle dynamics. Events in one industry group can have an effect on other industry groups. For instance, the Iraq War and the 9/11 terrorist attacks had a dramatic effect on military and defense companies. This in turn had an effect on electronic parts manufacturers, in particular companies that manufactured delicate measuring devices. In the 1990s, healthcare reform boosted HMOs, and that produced a need for cost containment companies and software to help those companies deal with patients and logistics. The advent of the personal computer had a direct effect on semiconductors. The proliferation of small handheld devices produced demand for 1-inch hard drives. High energy prices in the period 2006-2008 and ever-increasing worldwide energy use, as well as increased levels of pollution, have led to the proliferation of solar and alternative energy technology. Personal computing created the need for software and peripherals, which in turn led to the widespread use of the Internet, creating the need for faster speed and broadband access. Now, we see social media and cloud computing as new frontiers. You can be assured that future growth areas will show up in leading stocks of leading industry groups. When the leader sneezes, the group can get a cold. Just as leading stocks can at times foretell a powerful group advance, keeping an eye on the top 2 or 3 companies in an industry group could provide a tip-off to when the group may be headed for trouble. It's important to keep your eye on important leading names in the top-performing sectors. Often you'll see an important stock in a group break badly, and the whole group will suffer. If one or more important stocks in an industry group top, that could be a warning that the whole group will soon run into trouble. Even stocks that are outside the group, such as suppliers and customers, may share in the suffering. Historically, more than 60% of super performance stocks were part of an industry group advance. It pays to keep an eye on an industry's top stocks to get a feel for that group's potential strength. However, if a key leader breaks down after a big advance, beware. This is often the initial symptom that the entire group is about to get sick. New technologies become old technologies. Every innovation eventually ceases to be an innovation. In doing so, it follows a path of market penetration and eventual saturation. This is a timeless truth. Initially, every new innovation, railroads, automobiles, radios, televisions, computers, the internet, etc., begins at a relatively high price point that only a small market segment can afford. Progress in technology and manufacturing gradually reduces the relative price of the new product. This leads to market penetration, in which more and more potential users can acquire the new product or service. At some point, market saturation is reached. All firms or households that will buy and use the new product have access to it. Good examples are the automobile and the television. The market becomes largely a replacement market with overall unit growth bounded by the slow growth of the economy overall. Once a market reaches saturation, little room remains for further penetration. Relative price declines have less and less of a positive impact on unit sales. The industry ceases to be a growth industry. In some cases, technological and manufacturing progress may lead to price declines that exceed consequent increases in unit sales. During such periods of market saturation, competitive pressures usually lead to severe declines in profit margins. A former growth industry geared to rapid sales expansion enters a period of consolidation in which competition becomes unusually intense. Such periods of consolidation are usually characterized by profit rates well below the prior industry average, a decline in the number of companies in an industry, and bankruptcies. In the 1980s and 1990s, the PC-based high-tech industry underwent such a process of market penetration. This was no different from the experience of the automobile industry in the 1920s and the television industry in the 1950s. However, the cycle moved at a faster pace, probably as a result of the increase in information flow and access to world markets. Chapter 7. Fundamentals to focus on. When a stock suffers a major break in price, there's a reason, and very often it's the beginning of lower prices to come. In almost every case, something is fundamentally wrong with the company's business or industry. Entering 2008, many of the big banks, including Citigroup, along with their broker-dealer and investing banking cousins such as Lehman Brothers and Bear Stearns, were over-leveraged and held deteriorating balance sheets. This toxic cocktail would set up the financial sector for collapse, as the overall economy was stunned into a severe recession. From 2007 to 2009, former Dow component American International Group, AIG, crashed from a high of $103 down to a minuscule $0.33. On September 22, 2008, AIG was removed from the Dow Jones Industrial Index. Citigroup was removed from the Dow on June 8, 2009. You've heard the old adage about buying low and selling high, so maybe you figure this is a once-in-a-lifetime opportunity. That is, to buy GE, Citigroup, or some other familiar company while it's down in price. I bet those who bought the blue-chip carmaker General Motors in 2008 felt they were getting a bargain too. However, in just 1 year, GM stock dropped to a level not seen since 1933, shedding almost 95% of its value. On June 8, 2009, General Motors was also removed from the Dow Jones Industrials Index. The fact is, no matter how big or prestigious a company is, when fundamentals deteriorate, namely, earnings, you never know how far the stock will fall. What drives superperformance? The stock market cares little about the past, including the status of a company. What it cares about is the future, namely, growth. Keep in mind that our goal is to uncover superperformance stocks, shares that will far outpace the rest of the pack. These stocks are the ones with the strongest potential, and they seldom are found in the bargain bin. They are going strong because of a powerful force behind them: growth, real growth, in earnings and sales. Why buy damaged merchandise? If your goal is to achieve superperformance in stocks, each company must earn its place in your portfolio by being an outstanding business. Superperformance stocks show their strength through their ability to improve and grow earnings, sales, and margins. These powerhouse companies report quarterly results that are better than Wall Street anticipates, with upside surprises that propel the stock higher. Don't become enamored with a stock selling down in price because it has a well-known name. Many winning stocks may be companies that you never heard of before. Their best days lie ahead, not in the past. Regardless of a company's size, status, or reputation, there is no intelligent reason for an investor to settle for an inferior track record in a marketplace filled with companies with outstanding fundamentals. Each quarter, earnings and sales reports provide a refreshed set of statistics with new names, as those with poorer prospects are often replaced with those with greater potential. The same release of quarterly results also brings fresh data with which to evaluate the companies already in one's portfolio. In this way, the portfolio naturally evolves to achieve its performance goal through forced displacement. Stocks that continue to deliver the goods can remain in the portfolio, and the ones that fail to perform must go. Why earnings? In real estate, the mantra goes location, location, location. In the stock market, it's earnings, earnings, earnings. After all, it's the bottom line that counts. How much money can a company earn and for how long? This leads to three basic questions every investor should ask when it comes to earnings: how much, how long, and how certain. Profitability, sustainability, and visibility represent the most influential factors that move stock prices. To understand the impact of earnings on stock prices, let's go behind the scenes and examine how Wall Street operates. Who moves stock prices? Big institutional investors such as mutual funds, hedge funds, pension funds, and insurance companies. Many institutional investors, encompassing a relatively large number of investment professionals, use investment models that identify earnings surprises, that is, reported earnings that beat analysts' expectations. As soon as an earnings surprise is reported, these opportunists will jump on board, or at least put the stock on their radar screens as a potential buy candidate. Most of the big institutional investors utilize valuation models that are based on earnings estimates to determine a stock's current worth or value. When a company reports quarterly results that are meaningfully better than expected, analysts who follow the stock must re-examine and revise their earnings estimates upward. This increases the attention paid to a stock. The upward estimate revision is going to raise institutional investors' projected value of the company. When earnings estimates for a stock head up, shares, of course, become more attractive and invite buying. Anticipation and surprise. Stocks move for two basic reasons: anticipation and surprise. Every price movement is rooted in one of these two elements: anticipation of news, an event, an important business change or reaction to an unexpected event, and a surprise, whether positive or negative. Anticipation means expectation. For example, rumors that a large contract may be awarded to a contractor. In anticipation of an announcement, the stock price may advance. Once the deal is on the table and the contract is officially awarded, the stock could sell off. The same thing can happen with earnings that are in line with expectations. Once the announcement is made, the stock declines because that event had already been priced into or discounted in the stock price. Stocks often move in anticipation of good and bad news, and then after the fact may move in the opposite direction, i.e., rallying in anticipation of a favorable development and selling off when the announcement is made. This market phenomenon may baffle newbie investors. The reason for it is that the stock market prices in future events. That is what is meant when people say the stock market is a discounting mechanism. Although anticipation moves prices, Once the expected event occurs, the market sells on the news. Hence the old adage by the rumor, sell the fact. Surprises can take many forms, from earnings that were far above or below estimates to a sudden development that significantly changes a company's business outlook. What surprises have in common, by definition, is that they are unexpected. Suddenly, the idea of deregulating an industry catches on in Congress, or a drug that seemed unlikely to win U.S. Food and Drug Administration, FDA, approval unexpectedly gets the green light. With earnings, results come in well above expectations for a positive surprise or well below for a negative surprise. The earnings surprise. Let's define what Wall Street means by an earnings surprise. Simply stated, a company's earnings are better or worse than the consensus of analysts' estimates. You can find out what the estimates are for a company's earnings through news sources such as Yahoo Finance, Zacks, and Briefing.com. If a dozen analysts follow XYZ Corp., and the consensus average for quarterly earnings is $0.53 per share, if the company reports results of $0.60 a share, that will be a $0.07 positive surprise. If the company reports $0.48 a share, that will be a $0.05 negative surprise. A surprise could set off a flurry of activity, including a wave of buying that, in the case of a positive surprise, raises the stock price. Studies have shown that the effects of the surprise and the post-news drift, movement in the direction of the surprise reaction, can last for months. Efficient market theory holds that the market reacts instantaneously and fully prices in new information completely. Experienced traders know that this theory is false for several reasons. For one thing, it's impossible for everybody to respond at the exact same time. Liquidity is also a factor. Only so many shares are available to be bought and sold. Large buyers must buy over time to avoid running a stock up too quickly, and if they sell too fast, they can crush the stock. This is what accounts for post-earnings drift, a persistent bias in the direction of the surprise. Be on the lookout for companies that are beating earnings estimates. The bigger the earnings surprise, the better. The cockroach effect. They call it the cockroach effect because, as with cockroaches, if you see one, you can bet there are others. The same thinking applies to companies reporting earnings surprises. If a company has posted very good quarterly results that are much better than were anticipated by analysts, there are probably more good quarters ahead. If a company is performing well with earnings surprises, other companies in the same industry or sector may post some upside surprises as well. The prospect of further surprises may lead to speculation by institutional investors in some stocks even before the earnings come out. Such a strategy can be profitable. An authentic earnings surprise for the quarter probably portends higher earnings in the next quarter as well. The mirror effect often holds true for negative surprises. Companies that miss earnings estimates often disappoint again in subsequent quarters. Because earnings surprises have a lingering effect, we want to focus on companies that beat estimates and avoid firms that have negative earnings surprises. One way to find candidates is to check to see if earnings reported in the last couple of quarters were better than expected. Not all surprises are created equal. Not all surprises are really surprises. Sometimes a company will beat the published consensus number. For example, Company XYZ reports earnings of $1.23 a share versus the street estimate of $1.20. Although that's a $0.03 upside surprise, don't be unduly impressed with companies that beat analysts' estimates. News reports often emphasize that companies' announced earnings beat analysts' estimates by a penny or two a share. This isn't anything new. Companies more often than not beat their estimates. This happens because they're careful to guide expectations in their public statements during the quarter, ensuring that analysts' estimates converge around a number slightly below what management knows the company will deliver. It's also partly due to a herd effect among analysts who don't want their quarterly forecasts to be too far above or below the average of their peers. Analysts are typically conservative in making earnings estimates. Since the market likes upside surprises and Wall Street firms are in the business of selling stocks to consumers, you can see how this happens. When it comes to estimates, there is no benefit to being aggressive. If the majority of analysts are between, say, $0.25 and $0.30 a share in their earnings estimates, and the consensus is $0.27, who would want to crank up the earnings model to project $0.40 a share? Even a better-than-expected earnings report could look like an earnings disappointment. The stock could get clobbered, and as a result, the analyst could be out of a job. Being conservative and safe within a reasonable range of the consensus number makes everybody happy, especially if the company beats the estimates. Although it may look good on the surface, don't be fooled into thinking this is a true upside surprise. You are looking for a significant event with results that beat estimates by a meaningful margin. Years ago, it was popular to discern the whisper number on the street, a shadowy figure that was more realistic than the published estimate or consensus. The whisper number existed because company management once could legally share information within a closed circle of certain analysts. Those analysts in turn would share that information with their biggest clients. The Sarbanes-Oxley Act of 2002 silenced the whisper number with stricter rules that required companies to disseminate information in a more restricted fashion, with stiff penalties for violations. Even earlier, the Securities and Exchange Commission in August 2000 adopted Regulation FD, Fair Disclosure, to address non-public information that had not yet been announced, that could be disclosed by publicly traded companies. In general, the rule states that if a company releases certain information to certain individuals, such as analysts, it also has to make a public disclosure of that information. The purpose of the rule is to promote full and fair disclosure, according to the SEC. Analysts' revisions of estimates. When a company reports a meaningful earnings surprise, analysts who follow that stock are likely to revise their earnings estimates. I like to see estimates raised not only for the current quarter but also for the current fiscal year. Studies have shown that when estimates are revised upward by 5% or more, stocks tend to show better than average performance. Conversely, with downward revisions of 5% or more, stocks exhibit lower than average performance. Generally, adjustments to estimates following an earnings surprise are made shortly after the announcement. Sometimes, however, estimates are raised before an earnings report, for example, in the middle of the quarter. This reflects the expectation of good results. It may be that a product is selling better than expected or business conditions have improved. Analysts who follow companies very carefully revise their estimates not only based on historical data, but also because of what they learn by talking with customers and suppliers. As the reporting period approaches, estimates probably will start to converge around the consensus estimate. It's your job to watch a stock to get an idea of whether the price is already anticipating these expected results. Also note that when analysts raise their earnings estimates on the basis of the latest results, this lowers the price and earnings P/E ratio of a stock because the denominator, earnings, is larger. To calculate future earnings, analysts start with a revenue projection, such as all the contracts that a company has or says it will have. Then they apply the company's expected profit margin and subtract a certain percentage for taxes. The result is the earnings per share for the quarter or the year. Most of the inputs for an estimate come from company guidance in the form of press releases, conference calls, and personal one-on-one discussions with executives. The analyst may adjust the numbers in the earnings forecast on the basis of conversations with customers, who may indicate that sales are not as good as projected, or, conversely, better than the company has stated. Or the analyst may determine that the company is going to qualify for a lower tax rate. A competitor may be about to announce lower pricing, which will lead to a price war that will grind down profit margins. Look for companies for which analysts are raising estimates. Quarterly as well as current fiscal year estimates should be trending higher. The bigger the estimate revisions, the better. At the very least, I like to see the current fiscal year or the next year's estimates trending higher from 30 days earlier. If both are trending higher, that is even better. Although I won't necessarily disqualify a stock as a buy candidate if it lacks upward earnings revisions, large downward estimate revisions are definitely a red flag. Big earnings attract big attention. When a company delivers several quarters of strong earnings, this not only prompts more upward revisions of analysts' earnings estimates and brokerage upgrades, but also results in more coverage of the stock as additional investment houses assign analysts to follow the company. More upbeat analysis can lead to more buying. The stock, which was hardly noticed just a few quarters ago, is starting to attract attention and bask in the limelight. If earnings accelerate quarter by quarter at a strengthening pace, earnings per share (EPS) momentum can propel the share price even higher. As EPS momentum builds, for example, 10% earnings growth, then 30%, 50%, and so on, the earnings momentum buyers will jump on the bandwagon. A feeding frenzy is now underway, all of it fueled by EPS growth and expectations of future growth. As the stock's price rises quickly because of the prospects of improving fundamentals from institutional buying, additional quantitative models kick in, and price momentum players start to buy the stock purely on the basis of a strong price trend and price momentum. Some of these investors will buy stocks that show strong price action regardless of the fundamentals. They believe that a stock that is rising strongly will continue to rise over the short to intermediate term purely as a result of momentum. At some point, the growth becomes obvious and essentially everybody knows about it. The stock is officially termed a growth stock. The smart money that got in early is getting out with a hefty profit, and naive investors step in to buy what they've been reading about in the financial pages or hearing about on TV. Then the momentum stalls. What follows is the loss of EPS momentum, an eventual negative earnings surprise, and downward revisions, all of which puts considerable pressure on the stock price. This earnings maturation cycle happens time and time again, market cycle after market cycle. The key is to understand where you are in the cycle and take advantage of its effect. Get it on the table. Big earnings will eventually attract the big players and create the conditions for big price performance. The length of time a stock remains in stage 2 depends on the company's fundamentals, specifically, how long it's able to continue its pattern of strong earnings growth. Some companies can keep this up for quite a stretch. To take advantage of this phenomenon, you don't need to guess or predict, and you don't have to settle for less than stellar performance in terms of fundamentals. Look for stage 2 uptrends supported by strong earnings growth, and you will dramatically increase your chances for attaining big success in stocks. Sometimes a company with a rocketing stock price may not be making much money, but the rising price means that investors are hoping that it will be profitable in the future. However, 3 out of 4 times, the very best performers will show meaningful earnings increases in the most recent quarter from the same quarter a year earlier. You should demand not only that the most recent quarter be up by a meaningful amount, but that the past 2 or 3 quarters also show good gains. In fact, it's even better if the earnings are getting stronger sequentially each quarter. In our study of past superperformance stocks, as well as in the Love and Reingannum studies, current quarterly earnings showed the highest correlation with big stock price performance. To ensure that your stock is attractive to institutional investors, demand that a minimum level of current quarterly earnings performance be met before investing. Many successful growth managers require a minimum of 20 to 25% year-over-year increases in the most recent 1, 2, or 3 quarters. The greater the percentage increases, the better. Really successful companies generally report earnings increases of 30 to 40% or more during their super performance phase. In a bull market, you can set your minimum even higher. Look to find companies delivering increases in earnings of 40 to 100% or more in the most recent 2 to 3 quarters. Companies that report 4, 5, or 6 strong quarters in a row provide even more assurance that they are on the right track. It's important to know when the companies in your portfolio and the ones on your watch list will report quarterly earnings. It's not uncommon for a company to issue a pre-announcement about its results before the actual earnings date. You should, in addition, be aware of earnings reports and news from companies that are in the same industry group as the stocks you hold. The following are some examples of big winners that had their earnings on the table when they made a large-scale advance in price. March 1989 through May 1993, Cisco Systems, Cisco, reported 15 out of 17 quarters of earnings increases of 100% or more, with the other 2 quarters at 92% and 71%, respectively. Cisco's stock price advanced more than 13-fold during this period. September 1989 through December 1992, Home Depot HD reported 14 consecutive quarters of earnings in excess of 29%. Home Depot's stock price advanced more than 500%. From 1987 through 1991, Microsoft, MSFT, reported only 1 quarter below 36% for 16 straight quarters. The stock price advanced more than 1,200%. Apollo Group, APOL, reported 45 consecutive quarters at or above Wall Street's estimates. Apollo's stellar price performance qualifies it as one of the greatest stock market winners of all time. From 2009 through 2011, Green Mountain Coffee Roasters, GMCR, averaged quarterly earnings increases of 112% and quarterly sales increases of 67%. The stock price advanced more than 650% in 24 months. Amgen AM averaged quarterly earnings increases of 288% during its phenomenal run in the early 1990s. Crocs, getting in and getting out at the right time. Crocs Inc. Crocs was a flash-in-the-pan retail fad, similar to a sneaker company I traded in the 1980s called LA Gear. Both had meteoric price surges in a relatively short period because of rapid sales of their trendy shoes. Initially priced at $9.90, Crocs opened up 200% at $30 per share on February 8, 2006. Crocs boasted triple-digit earnings per share every quarter from June 2006 until September 2007. From its initial public offering through October 2007, quarterly earnings per share averaged 229%. The stock advanced a whopping 400% during that period. Hot one-product stocks that go from unknown to all the rage overnight can be great investments if you get in and get out at the right time. Crocs skyrocketed while business was booming, albeit briefly. There are countless examples of companies that produced huge earnings growth as a result of a cyclical fad. While a product is selling rapidly, there can be a great deal of enthusiasm over the company's shares. Whatever the reason, some sort of positive development in the company is accelerating the growth rate and the share price. Although this rate of growth is not sustainable forever, no company can do it indefinitely. It may last for 6, 9, or 12 quarters, or even longer with strong EPS momentum. If you get on board during this period of strong earnings growth, the stock can rally 100% or even rise by 300, 500, or in some rare instances 1,000% over a year or two. Vickers, triple-digit earnings propels stock. The earnings cycle phenomenon is not a one-time event or something unusual. It happens time and time again, market cycle after market cycle. The only thing that changes are the names. In 1991, I purchased shares of the electronic equipment manufacturer Vickers Corporation, Vickers, which advanced more than 400% in less than a year. This was due to a rapid earnings spurt from sales of a patented approach to providing the electricity used for sensitive electronic equipment called a zero-current switch. From September 1990 through September 1991, Vickers reported triple-digit percentage growth in its quarterly earnings. This was a tremendous performance that accelerated the stock price 460%, from a split-adjusted $4 a share to over $22. As you can see, big profits can be made while earnings growth is strong. Some price moves are meteoric. The key is to focus on the stage 2 portion of the cycle while the company is delivering strong quarterly EPS growth. Earnings acceleration. In addition to large earnings increases that are better than analysts expect, I'm looking for earnings acceleration, meaning that the growth in earnings is larger than it was in a previous period. More than 90% of the biggest stock market winners showed some form of earnings acceleration before or during their huge price moves. For instance, let's say that 4 quarters ago the company reported a $0.05 decline year-over-year in quarterly earnings. 3 quarters ago, earnings were up 10% year-over-year. Then, 2 quarters ago, earnings were up 28%, and in the most recent quarter, results are up 56%. That's 3 quarters of earnings accelerations. Year-over-year, earnings are growing by an increased rate sequentially, quarter to quarter. This characteristic is very positive and has been shown to exist in most of the best-performing stocks. Look for earnings supported by revenue. In addition to strong, accelerating earnings per share growth, you want to see sales exhibit the same characteristics, strong quarterly growth and acceleration. It's not uncommon for new market leaders to show triple-digit sales growth in the most recent 2, 3, or more quarters. In fact, some great stock market successes deliver large quarterly sales increases consistently for several years. For example, from March 2009 through December 2010, Netflix reported 8 consecutive quarters of sales increases that accelerated from 21% to 34%. During that period, quarterly earnings averaged 45%. Netflix's stock price advanced more than 500%. Home Depot made a 698% move from June 1982 to June 1983. Its sales grew 104%, 158%, 191%, and 220%, respectively, over the 4 quarters leading up to this major stock price jump. In 2010, accelerating sales bolstered earnings and propelled shares of F5 networks more than 500%. This is what really accounts for superior stock performance, strong earnings growth backed by brisk sales, not accounting gimmickry. If you demand that your stock selections not only show strong earnings but also show strong sales, you will increase your chances of latching on to a super performer. Check the trend. Generally, I look back 1 to 2 years to see if there has been some form of earnings and sales acceleration. Life is not perfect, and so if 1 quarter here or there doesn't accelerate, it may not be a big deal. You can smooth out quarterly results by using a 2-quarter rolling average over the past 4, 6, or 8 quarters. Ideally, you want to see a steadily improving trend. In contrast, a trend of a material deceleration with results trending sharply lower for several quarters or longer should raise suspicion. Annual earnings. If a company is truly doing well, its success is unlikely to end overnight. A surprisingly good earnings report could be the beginning of a string of successful quarters. Strong quarterly results should translate into strong annual results. Just 1 or 2 quarters of good earning isn't going to be enough to drive a stock's price significantly higher for an extended period. One of the most successful stocks of the last several decades was Apollo Group. From 2000 to 2004, Apollo's stock price accelerated from $10 a share to $96. During that period, annual EPS growth averaged almost 40%, accelerating from 28% in 2000 to 55% in 2003. This is the type of growth that fuels super performance. In addition to quarterly growth, look for strong annual growth. Look for a breakout year. You can go back 2 to 4 years or more to a record year and see if current earnings are breaking out above the previous trend. It can be a fairly significant event if earnings suddenly break out to the upside from a range that was established over several years. Finally, check the upcoming 1 or 2 quarters as well as the next fiscal year to see if earnings acceleration is expected to continue. How to spot a turnaround situation. Another form of earnings acceleration to look for is a turnaround situation. A stock had been doing well but then fell on hard times. During the difficult period, the company probably had some negative earnings surprises, for example, growing at a slower rate than expected, growing by only a single-digit percentage, or perhaps reporting negative results. In some quarters, earnings may have declined compared with the year-ago period. Then, all of a sudden, earnings growth explodes. The company reports quarterly earnings that are up 50% from the prior year period, and the next quarter it shows a greater than 100% year-over-year gain. In the subsequent quarter, results are up 150%. Amplifying this performance are the easy comparisons from the prior year when the company was struggling. Now, as things start to turn around, not only is the company able to post higher earnings, the gains on a percentage basis look dramatically better. With turnaround situations, investors should insist that the current earnings be very strong plus 100% or better in the most recent 1 or 2 quarters. If the previous results were dismal, the company should be doing significantly better percentage-wise in light of easy comparisons. You could also insist that earnings and margins be at or close to a new high for added confirmation that the company is back on track. In some cases, you can spot turnarounds and earnings acceleration by comparing the current annual growth rate or current quarterly results with the 3 or 5 year growth rate. A company that has been growing 12% a year and suddenly starts to show growth of 40%, and then 100% could be a hot prospect. Deceleration is a red flag. A company can be doing great with high double-digit percentage growth and then deteriorate to mid-double-digit growth. For another company, growing by 20 or 30% may be a big improvement. However, for a company that had been growing at upward of 50 to 60% or more, a growth rate of 20 to 30% would be a material deterioration. Consider what happened with Dell Computer, which from 1995 to 1997 had grown its earnings per share at 80% annually, and then declined to around 65% in 1998 and 28% in 1999. Although this was still decent growth, it was a material change and marked the end of the tremendous move in Dell's stock price. The stock peaked in 2000. 10 years later, Dell's stock price was considerably lower, down more than 80% from its high. Home Depot. After a 5-year period of stagnation that began in 1994, when Home Depot was clearly in a sideways stage 1 pattern, the stock entered an acceleration phase in 1997. Earnings shown on an annual basis rose by 21% that year, followed by an increase of 37% in 1998 and 41% in 1999. This demonstrates how a stock performs best when earnings have the strongest rate of growth. Home Depot stock advanced from $10 a share to a peak of over $70 a share. What fueled Home Depot's price growth was an average annual EPS growth rate of 27%, which accelerated in 1998 and 1999. The peak for Home Depot stock was in 2000. After a strong earnings performance in 1999 with a 41% growth rate, EPS momentum slowed dramatically. In 2000, EPS growth was only 11%. The deceleration brought the stock down from its lofty levels as average annual EPS growth from 2000 to 2007 was 15%, almost half of what it had been during the upward momentum phase. Home Depot shares performed poorly during the slower growth period. This was due to the stock price running up ahead of its earnings and then eventually falling victim to earnings deceleration, which can happen when a growth stock becomes too popular. In summary, institutions like to see the following: earnings surprises, accelerating earnings per share (EPS) and revenues, expanding margins, EPS breakout, strong annual EPS change, signs that acceleration will continue. Chapter 8. Assessing earnings quality. A company can generate earnings in various ways, some not so trustworthy. I prefer high-quality earnings. In other words, where did the earnings come from? Did the company post better results because of stronger sales? If sales were strong, was it only because of a single product or one major customer? In that case, the growth is vulnerable. Or are the surprisingly strong results due to an industry-wide phenomenon or an influx of orders from numerous buyers? Maybe the company is slashing costs and cutting back. Earnings improvement from cost-cutting, plant closures, and other so-called productivity enhancements walks on short legs. Such improvements can show up from time to time, but sustainable earnings growth requires revenue growth. Examining earnings quality gives you perspective and rationale before you commit your hard-earned money to a stock. Non-operating or non-recurring income. Depending on how you examine a company's quarterly report, it can look like a roaring success or a sagging sloth. It's all a matter of perspective. Here's how this can happen. Zeiss Corp. reports $3.01 per share versus $2.40 the year before. This shows a hefty earnings gain of 25%. Looks great, right? On closer examination, you notice that XYZ Corp. reported an unusual gain related to the sale of non-strategic assets. This one-time event accounted for $0.84 per share of income and is considered non-recurring. Therefore, this gain should be excluded from XYZ Corp's earnings. Doing this will result in an adjusted number of $2.17 a share, which is down 7% from the year before. Big difference. I'm looking for earnings that come from core operations, not from a one-time gain or an extraordinary event. Most of the time, the difference between operating income and non-operating income is clear-cut. Consider a company that sells coffee. Some of its stores are on company-owned real estate, and management decides to divest some of the properties in the belief that commercial real estate prices are high. These property transactions and the profits they generate are clearly outside of selling coffee. Therefore, any gain on the property sale would be a non-recurring event or extraordinary gain that should be stripped away so that earnings reflect income from operations derived for the company's core business. Beware massaged numbers. Management has become adept at managing expectations and massaging numbers in an effort to underpromise and overdeliver. The game players may even underdeliver by dropping an earnings bomb in an effort to have the estimate bar temporarily lowered for easy comparisons in the future. One gimmick is to warn the public of a potential earnings problem, which will cause analysts to lower their earnings estimates. Then the company reports earnings that are better than the lowered estimate. This will result in an earnings surprise. However, it will be a surprise in the context of a lower consensus comparison. If you see that estimate revisions were recently lowered due to downside guidance, and then the company beat expectations, this should raise a red flag. The report may not be as good as it looks on the surface. One-time charge. Another smoke and mirrors trick is to utilize a one-time charge or a non-recurring charge. A company that would otherwise report weak earnings may, in fact, report a non-recurring one-time charge that will account for a portion of the earnings. It's just a one-time expense, and business will be back to usual, right? Wrong. Not if this practice forms a pattern. Some companies are habitual abusers of the one-time charge. If the one-time charge is showing up over and over, you should seriously question the earnings quality of even the largest and most respected corporations engaging in this practice. Write-downs and revenue shifting. Inventories, write-downs, and ongoing expenses are also items to look out for. Some companies will bottle up and store write-downs for a later date when they'll need them. They may choose to recognize or shift revenues or expenses into the future or a different accounting period, which allows them to control in which quarter they will realize charges or recognize sales. Some companies will record revenues and accounts receivable at the time they ship product and estimate losses only for returned merchandise. If returns run higher than is accounted for, it could affect future earnings. Management may also choose to shift earnings so that a hit can be absorbed in a single disappointing quarter. By shifting earnings to have one big down quarter, the company can beat estimates in the next quarter because the previous report prompted analysts to lower their estimates, making it easier for the company to beat the street. You want to see earnings coming from robust top-line sales, not from accounting tricks and gimmicks. Beware profitability via cost-cutting. With an understanding of the three major drivers of earnings: higher volume, higher prices, and lower costs, it pays to be cautious if a company is delivering only on cutting costs. A company can increase profits by cutting jobs, closing plants, or shedding its losing operations. However, these measures have a limited lifespan. Eventually, a company will have to do something else to grow its business and increase its top line. Therefore, check the story behind earnings growth. Make sure that it's not because of a one-time event, because sales jumped as a result of some extraordinary gain, or because profits improved only as a result of cost cutting. Companies with good potential for stock price appreciation show evidence that earnings growth is sustainable and will continue over some length of time. The ideal situation is when a company has higher sales volume with new and current products in new and existing markets, as well as higher prices and reduced costs. That's a winning combination. In general, the best growth candidates have the ability to expand, introduce new products and services, and enter new markets. They have the power to raise prices, and they can improve productivity and cut costs. The combination of revenue acceleration and margin expansion will have a dramatic effect on the bottom line. The worst situation is when a company has limited pricing power, its business is capital intensive, margins are low or under pressure, and it's faced with heavy regulation, intense competition, or both. An example would be the airline industry, which doesn't have much pricing power, faces government regulatory pressures, is very capital intensive, and is highly commodity sensitive because of fuel costs. When strong earnings are reported, check the story behind the results to make sure the good news is not due to a one-time event, but is the product of conditions that probably will continue. Your questions should include the following. Are there any new products or services or positive industry changes? Is the company gaining market share? A market is ultimately dominated by just a few companies. What is the company doing to increase revenue and expand margins? What is the company doing to decrease costs and increase productivity? Measuring margins. The objective for any company is to retain as much money as it can from the revenue it generates, meaning that it has the highest profit margin possible. When margins expand, the company is getting a higher price for its products or has found a way to improve productivity or cut expenses, sometimes both. Increasing margins show that more profits are being made for each dollar of sales the company makes. Margin metrics come in different varieties. Gross margin reflects how much more customers pay for a product compared with the company's costs. It shows investors how well a company is doing in keeping its costs in line and pricing its products. Gross margins depend on quite a few variables, some of which may be beyond the company's control. For example, if raw material costs were lower one quarter, or if a competitor had a delivery problem that gave the company an unexpected advantage, that could be a short-lived phenomenon. The best kind of margin improvement comes from pricing power because of strong demand for a company's products. Net margin is based on a company's net income divided by sales and reflects all the variables that influence profitability. A falling net margin indicates that the company is making a smaller profit on its sales. This could be due to rising costs, inefficiencies, or taxation. Margin pressure can cause serious profit erosion. The cause of a decline in net margins could be temporary in nature, such as a short-term rise in raw material costs or temporary inefficiency in the production system. Far more worrisome is when the net margin declines, because prices are dropping as a result of declining customer interest. A company with a strong net margin compared with the average in the industry has a competitive advantage. A comparison of net margin across companies in an industry can be used to gauge the quality of management. A well-run growth company should show consistent improvement in operating margins and net profit margins. Where the rubber meets the road. No matter how good an earnings report appears to be on the surface, you want to pay close attention to the stock's price reaction to determine how good the report really was or was perceived to be. One way to do this is simply to watch how the stock trades initially and over subsequent days after the earnings release. If the report really was great, you should see a strong stock price reaction that holds up and is supported by additional buying on reasonable pullbacks. I like to see the stock price react strongly to the report and hold its gains. To determine whether the market is looking favorably on a company's earnings, I watch for 3 specific reactions. 1. Initial response. Did the stock rally or experience a sell-off, If it's sold off, does it resume its slide after a dead cat bounce, or does the stock price come roaring back? 2. Subsequent resistance. How well did it hold its gains and resist profit-taking? 3. Resilience. Did the stock recover quickly and powerfully? Or did it fail to rally after a pullback or, worse, sell off? As an investor, you won't know for sure what Wall Street is looking for in an earnings report until you see the stock's reaction to the report. When an upside surprise is announced, I expect the stock price to do pretty well. If that doesn't happen, say the stock goes up briefly but then sells off and is down 15% and can't rally, that's a big problem. This type of reaction tells me that something may be wrong. Although it's not uncommon for stocks to sell off on profit-taking after a big rally and decline on news, a superperformance stock will come back and resume its advance. For a true superperformer, there should definitely not be a huge sell-off that breaks the whole leg of the stock's upward move. After a company reports its earnings, my focus turns to the post-earnings drift, PED, which suggests that it may not be too late to buy a stock after it has reported better than expected earnings. Even if you miss the first upward reaction after results are reported, the post-earnings drift after a significant surprise can last for some time. Stock price movements from significant earnings surprises not only are felt right way, but can have a longer-term effect beyond the immediate price adjustments. Many studies have shown that the effect can persist for months after an earnings announcement. Sometimes earnings are largely discounted, meaning that expectations for an earnings surprise were already priced in. Because such high expectations had been discounted in the stock price, even an earnings surprise will not satisfy the market. If earnings came in at, say, $0.05 a share over expectations, but that level of outperformance was already anticipated, this will be a disappointment to the market, which had hoped for an even bigger surprise, say, $0.07 or $0.10 a share. Even if the consensus was $0.50 and the company reported $0.55 a share, the stock could sell off because earnings did not come in even higher. How do you know what the market wants other than the published estimates? Study how the stock price responds. Was the stock rewarded or punished when the results came in? Was an upside surprise big enough to move share prices higher, or did the stock sell off? Even if an earnings report appears to be a surprise, you can judge the true perception only from the response of the share price. Unexpected surprises can have a dramatic effect. Company-issued guidance. Company-issued guidance is simply comments that management provides publicly about what it expects in the future. These comments are also known as forward-looking statements and generally focus on earnings, sales, and margin expectations. Company guidance is given so that investors can evaluate the company's growth potential. Under current regulations, it is the only legal way a company can communicate its expectations to the market. Analysts use this information in combination with their own research to develop earnings forecasts. Company-issued guidance plays an important role in the investment decision process because management knows its business better than anyone else and has first-hand information on which to base its expectations. Be aware, however, that management can use guidance to sway investors. For example, in a bull market, some companies have given optimistic forecasts because the market wants momentum stocks with fast-growing earnings per share. In bear markets, companies have tried to guide expectations lower so that they can beat the earnings projections. Companies generally issue guidance at or near the time a quarterly earnings report is released. Let's say that along with reporting stronger than expected earnings, the company issues guidance for the upcoming quarter and the rest of the year, projecting much better earnings ahead. For example, the company may say that for the next quarter it expects to earn $0.10 to $0.12 a share more than it previously predicted, and it also increases the expectation for year-end results by $0.30 to $0.35 a share. Not only has the company beaten the expectations for this quarter, it feels confident enough that it will have good results the next quarter to go public with a statement to that effect. Because companies are conservative about their earnings guidance, We know that a statement like this won't be issued unless management thinks the results will not only meet these higher expectations, but also beat them. This is exactly what I'm looking for, better than expected earnings along with positive earnings guidance. A company should not only be doing well but be doing better than analysts anticipate. Depending on what a company says about its business prospects going forward, positive or negative, the response of the stock price could be dramatic. In some cases, the reaction to earnings guidance is stronger than the reaction to the actual earnings report when it is announced. By tracking what a company says, and then what develops later on, you can ascertain the quality and tendencies of the company's guidance. If you think earnings expectations don't drive stock prices, watch what happens when a company announces earnings that fall short of expectations even by just a few pennies, or when it issues downside guidance. Rosetta Stone, Inc. (RSD) raised its guidance for third quarter and fiscal 2009 results in July 2009. After a brief pullback, 4 days after guidance was raised, the stock sold off and could not rally and recover. This was abnormal considering the rosy guidance. Just days later, the company flip-flopped and issued lower guidance, and the stock got blasted. It simply did not make sense that the stock broke down and couldn't rally after what should have been perceived as great news. This was telling of the future. The fact that the company lowered guidance just 11 trading days after it had raised guidance was a bewildering red flag. As you can see from the previous Rosetta Stone example, company-issued guidance can send a stock soaring or plummeting depending on how it is perceived by investors. In February of 2003, Dick's Sporting Goods, DKS, gapped up big after the company issued positive forward guidance. The overwhelming volume was revealing, a telltale sign that institutions took comfort from the news. Long-term projections. When obliged to fess up to bad news, a publicly traded company will often try to spin the message. It may announce a stock buyback or some other positive news at the same time it reports a disappointing quarter in an effort to soften the blow and offset any potential negative effects. This generally doesn't work. One feeble tactic is to issue an upbeat long-term projection at the same time they deliver bad news about an upcoming or current quarter. In dealing with future earnings, it's important not to look too far out. Growth investors tend to have a "what have you done for me lately" mentality. Therefore, focus on what the company is saying about the upcoming quarter and the current fiscal year. My rule of thumb is to take long-term forecasts with a grain of salt. No one, not even management, can accurately forecast what a company will earn or what its rate of growth will be a year or two down the road. If they say, "Business conditions will be tough this year, but we see improvement coming next year," that's not positive guidance. That's spin. Analyzing inventories. Back when I first started trading stocks in the early 1980s, public companies were not required to report inventory figures. Now those figures are readily available. Inventory figures can be found in the published balance sheets of a corporation, which are available in 10Q quarterly and 10K annual filings to the Securities and Exchange Commission, SEC. Companies post the filings on their websites. Corporate filings also are available on the SEC's Edgar database. With a manufacturer or retailer, inventory and accounts receivable analyses can provide a heads-up as to whether business conditions are likely to improve or if the good times are coming to an end. In late 2003-2004, the price of copper was going through the roof. This rapid escalation in the price of a raw material, I knew, would enable manufacturers of copper products to pass along a price increase to customers. By examining the inventory figures in the quarterly reports of several manufacturers, I found my candidate, Encore Wire. Encore possessed significant copper inventories and met the criteria of my SEPA stock analysis. I knew I had a potential big winner in sight. Encore had a stockpile of copper it had bought at lower prices. With the price of copper significantly higher, Encore could charge its customers significantly higher prices than it paid, which accounted for expanding profit margins. Compare inventory with sales. For certain industries, such as manufacturing, the comparison of inventory and sales is crucial. Specifically, I look at the breakdown of inventory, i.e., finished goods, work in progress, and raw materials, and how each segment relates to the others. The inventory breakdown also helps put sales in perspective. For example, a strong gain in sales may look impressive. However, the company could be pushing on a string if in fact inventories are growing much faster than sales. If the finished goods portion of inventories is rising much more rapidly than the raw materials or work in progress segments, this could mean that product is piling up. Therefore, production will slow because the company already has a stockpile of finished goods. If that inventory of finished products is highly depreciable, such as computers and certain retail goods, this could spell trouble ahead. A company sitting on a large stock of depreciating merchandise will have to slash prices to get rid of it. Also, that aging inventory will compete in the marketplace with newer product lines. Higher trending inventories can lead to markdowns and write-offs, a scenario ripe for a hit on future earnings, causing the company to report a disappointing quarter. Keep in mind that the amount of inventory by itself is not that meaningful to your analysis. It's the trend in inventories versus sales and the percentage increase or decrease within the inventory chain that yield valuable information. Think of inventory as merchandise waiting to be sold. Under most conditions, inventories should rise and fall in a pattern similar to that for sales. Management tries to anticipate future sales and stocks inventory to meet demand or expected demand. When inventory grows much faster than sales, it can indicate weakening sales, misjudgment by management of future demand, or both. These scenarios are likely to undermine earnings. The more rapidly inventory depreciates, the more excess inventory will be detrimental. Dell's solution for inventory build-up. Companies that control their inventory the best in an environment of falling prices have the potential to hold up best and outperform the others, especially during an economic downturn. Dell Computer responded to this problem with its revolutionary build-to-order business model. The model transformed the manufacturing business by lowering inventory stockpiles and decreasing the risk of holding depreciating computers. Other companies have since adopted this simple concept, even in industries outside the computer business. Dell's model is based on orders taken over the phone and on its website. Computers are not put into production until an order is placed. This dramatically reduced the number of days inventory was held and increased the company's inventory turnover ratio to more than 3 times that of its rivals. This unique new business model allowed Dell to capture higher profit margins than its competitors, gain market share, and dominate the computer market during the 1990s. The reason this concept worked so well in the computer business is that the product was highly depreciable. Virtually all of Dell's competitors relied on a business model that involved stocking retail stores with merchandise. When business turned down, Dell's competitors were holding large inventories of merchandise, the value of which was eroding with time and advances in computer performance and capabilities. To keep their merchandise from spoiling like fruit in the sun, Compaq, Hewlett-Packard, and Gateway were forced to cut prices to unload their stockpiles. This condition will often show up in inventories, with finished goods usually rising and trending upward faster than sales and raw materials. Not all inventory build-ups are bad. Maybe a company has to fill the shelves of 20 new stores it just opened. The real red flag arises when an inventory build-up is unexplained or the explanation isn't a good one. If you spot an unexplained inventory build-up, you can call the company or go on an investor conference call to ask for an explanation. On the flip side, if raw materials are suddenly building up, this could be an indication that the company believes business will be picking up. If that's the case, sales should show signs of acceleration shortly afterward to confirm that the raw material buildup was indeed in anticipation of stronger demand. Analyzing receivables. In addition to inventories, a part of a company's balance sheet that merits attention is receivables. Accounts receivable are what the company is owed for sales it has already made. Some receivables are to be expected in the course of doing business. It's normal to have a reasonable delay between delivery of products or services and receipt of payment. However, if receivables are increasing at a far greater rate than sales, or if the trend is accelerating, this could be a warning that the company is having trouble collecting from its customers. If receivables and inventories are both increasing at a greater rate than sales, twice or more without explanation, this could be double trouble. Think about it. We know from the previous discussion that when inventories, particularly of finished goods, rise faster than sales, that means product is building up. The company has made more than it can sell in current market conditions, assuming that there isn't a good reason for the build-up, such as the need to stock new retail outlets. This is even a bigger problem if the inventory stockpile is of highly depreciable goods. When receivables are also rising, the company hasn't been paid for what it has sold to its customers. This is a double whammy that often forecasts trouble ahead. Consumers aren't buying, and retailers aren't selling and therefore aren't able to pay for the product they've got. The manufacturer isn't collecting on what it sold, and its warehouses are full of more product than it can ship. There could be a reasonable explanation for the rising receivables, such as a new product line or new customers in a different industry that have been given longer credit terms. Maybe orders have not shipped as expected because of a production delay. Whatever the reason, it's worth investigating to see if this is a red flag or a situation that's easily explained. In the example below, the rate of increase in total inventories is 4 times that of sales and receivables are up 3 times the rate of sales. More troubling is the fact that finished goods and work in progress are up big relative to raw materials. This could indicate an unusually large stockpile of goods. To the extent that those goods are depreciable, the product on hand will be worth less and less as time goes by, eroding margins and ultimately earnings. This type of scenario should raise a red flag, differential disclosure. When a company says one thing in one document and something quite different in another, you have differential disclosure. This happens far more often than most people think. The reason is simple. Guidelines for reports to shareholders are far less restricted than those for reports submitted to the SEC. An example is shareholder reporting versus tax reporting. Make a point to compare footnotes and other disclosures related to taxes under the cash basis accounting rules required for the Internal Revenue Service, IRS, with the earnings reported to shareholders under accrual accounting. If you spot a big difference, this is a red flag. In a similar vein, if a company is reporting great earnings but is not paying much in taxes, be skeptical. Hitting on all cylinders, the code 33. When a company grows its sales at an accelerating rate, 25%, then 35%, then 45%, and so on, this is great. Better still, though, is a company that accelerates its sales and expands its profit margins at the same time. This powerful combination can ignite earnings and fuel explosive stock price appreciation. The result is a condition in which the company can grow its earnings at a much faster rate than it could if sales or margins were accelerating only by themselves, or if neither were accelerating. The best situation for rapid earnings growth is to be hitting on all cylinders, as sales accelerate and profit margins expand simultaneously. Look for what I call a code 33 situation. 3/4 of acceleration in earnings, sales, and profit margins. That's a potent recipe. If a company has hot-selling products or services and a management team that's on the ball, the proof should show up in the sales and margins. Profit margins should improve as the company improves productivity. Sales should increase as the company expands into new markets. If these things aren't happening, it may not be the optimum time to buy the stock.
Thank you for listening to this audiobook. We truly appreciate your time and support. If you enjoyed the content, don't forget to subscribe to the channel, like this video, and share it with others who may also benefit from it. Your support helps us bring more great audiobooks and learning resources to you.